Well, welcome. Tonight is March 14th, 2023, and we wanted to welcome you to our monthly IBD meetup. The title of our meetup this evening is the FDIC Bailout Contagion Part 2. For all of you that are following the markets closely, you're aware of the contagion and the volatility that's taken place over the last 3 or 4 days as a number of banks have closed, and the Fed has bailed really the depositors out nationwide because of the potential contagion. This is very similar to that 2008 great financial crisis, but the FDIC is getting in front of the possible and potential contagion that's going on. Anyway, we're a private group of over 2,000 investors, and we meet in this forum monthly to discuss the market conditions, market direction, individual stocks. And we've been doing this for many, many years. My name is Roy Maddox. I'm the chief market strategist of a firm here in Charlotte in Integrated Financial Strategies, and my partner is my son, Wesley Maddox, who is on the call as well, and who has prepared these slides for your perusal. Let me give you a little bit of background about me. I met Bill O'Neill, who is famous for launching Investors Business Daily, along with an entirely unique research department. And also he's famous for launching the newspaper Investors Business Daily that's been a stalwart for many investors over the past 35 years. He's also written the bestseller, How to Make Money in Stocks, and that's really the textbook and Bible, if you will, financial Bible that we utilize in terms of discussing the market, in terms of looking at the methodology that we're trying to use to identify the great leading stocks in the marketplace. We'll have many people on the group tonight that are novices, as well as very experienced veterans. And we certainly want to have the feedback from the veterans to provide to the group. It's always useful to hear what everyone else is seeing and what everyone else is doing in the market conditions. Tonight's agenda will be divided into 2 sections. I will have a brief introduction, go through a few slides, and then Wesley will go through the remaining portion of our slide deck. That will be part 1. And in part 2, we'll go through individual stocks. We do believe that a number of the members here have identified and will identify the great new leading stocks in the market. The question is the market environment conducive for that or not? So far, the market environment has been treacherous, and we haven't been able to get any traction because of the volatility. And many breakouts have not been working in a great market environment. You want to see a wealth of stocks making new highs versus stocks making new lows that are very, very narrow. And we're not seeing that environment currently. But remember, we're only 3 days away always from a change in market direction. So we'll discuss that and discuss the potential follow-through day that may come as early as Thursday. So with that, let's get started on the slide deck. And this is just a slide which tells you a little bit about our group. You can find us online if you just Google Charlotte Investors Business Daily Meetup Group. And of course, this is a disclaimer. I am, as well as Wes, are licensed financial advisors, but the information that we're sharing tonight is not intended in any way to be investment advice. Please conduct your own research and talk to your own financial advisor before you take and utilize any of the ideas that members provide in this meetup tonight. This is the famous acronym, of course, CAN-SLIM, and this is the focus. This is the focus of the characteristics of great leading stocks that we're trying to find, because Bill O'Neill identified these characteristics as being found in the great leading stocks of the past 100 years. And this this goes in depth in the book How to Make Money in Stocks, and there's a 4th edition out. And I incidentally have the original version signed by Bill O'Neill when I met he and David Ryan in 1988, and that is one of my most treasured possessions, because both of those guys really changed my life over the last 35 years. We're suggesting that you should have some type of process and not address the market in a haphazard way. And we've just put together some helpful hints that we think that you might utilize in terms of describing a process that you may utilize. And we believe that a proper process should be based on technical analysis, fundamental analysis, and macroeconomic analysis, and we'll tell you why. Excuse me. Technical analysis is really using charts to identify and navigate through the marketplace, and really utilizing supply, demand statistics, breadth, volume, and price action. And some of these technical indicators that we commonly use are the moving average, convergence, divergence indicator, relative strength, stochastics, point and figure, rate of changes in various indicators, and most importantly, the trend. We had a conversation with a client earlier today, and she was wanting to know how important the M is on CAN-SLIM. Well, it's very, very important. It's almost impossible to make money when the market's in a downtrend, because 75% of stocks go down when the market is in a downtrend, and the market currently is in a downtrend. We identify the short-term trend, however, when the 10-day exponential moving average crosses above the 21-day exponential moving average. We look at the intermediate term trend direction as positive when the 21-day crosses above the 50-day moving average. And most importantly, we're looking at the 30-week moving average and a close of 2 consecutive weeks above the 30-week moving average to say you're in a long-term uptrend. So it's important coming out of a market correction, which we're in a market correction now. And I believe this was day 2 of an attempted rally. And we're looking for a potential follow-through day. That's a day where the market is up over 1 point. We would say in this, based on where the market is now, say 1.7% higher on higher volume than the day before on any of the indexes. But we primarily use the NASDAQ and the S&P 500 index. In determining the breadth of the market, we look at various charts to see if to see how weak the market is or how strong the market is based on stock participation. Stock participation is always important in a sustainable uptrend because you want to have more stocks participating. Yesterday, we had, I believe, 900 stocks making new lows and maybe 30 stocks making new highs. That's just the opposite type of underlying condition that you want to see in a market uptrend. So it's almost impossible to make money as the market's just going sideways and with the short-term bias that's lower right now. And we'll talk about that later today. And in terms of sentiment, we look at the NAAIM. That's a National Association of Active Investment Managers exposure index, and that takes all money managers and mutual funds and hedge funds, and through a survey to see how they're invested, how much they're invested currently. And I believe that number is about 60% currently. we look at the VIX, which is a volatility measure, and we look at the put-call ratio. We also look at the high-yield index option adjusted spreads to identify if the market is healthy or not, healthy or not. And then, of course, we look at various ratios to see, well, is growth outperforming value, or is it small cap versus large cap? Are stocks outperforming treasuries? What about treasuries versus junk bonds? And that also provides very, very useful information. Currently, small caps are lagging, and because the Russell 2000 consists of many bank stocks and small cap growth stocks and bank stocks, and those are the stocks that have had a tremendous sell-off, in the last 3 to 4 days. This is a more descriptive screen, which identifies some of the things that we're looking at to do your fundamental analysis. Fundamental analysis is always important to see if you can find in determining how to find the next great true market leaders. And Investors Business Daily, they have a digital version, and you can have all these screens run to identify the leading stocks based on sales, return on equity, margins, relative strength rank, earnings per share rank, and so forth. And we utilize all that in terms of identifying the best performing stocks in the marketplace today. Macroeconomic analysis, we think, deserves a mention, and we rely on Keith McCullough of Hedgeye Research to provide us with his macroeconomic analysis. And he's got a macroeconomic model that's really based on rate of change in growth and GDP, rate of change in inflation. And then he believes if he can get that right, then you can front run Fed policy. That's important. And I think Fed policy, and you can see right now that it is driving the market up or down right now. It's the most important part of the equation right now. And it's certainly important to pay attention with what the Fed is going to do and what the Fed has done and what they're saying and jawboning at one side of their mouth and actually what they're doing. And we will talk about later on in the presentation, we'll talk about our outlook in terms of inflation and where interest rates are going. Keith believes we're in a quad 4 model right now, and where growth is slowing and inflation is slowing. And we know that inflation has peaked over 9%. It came in today at 6%, right on the screws, right on the market consensus. So why is this important? It's important because depending on what quad you are in terms of the economic cycle, that typically dictates, well, what type of exposure you should have to each individual industry group. And in the current market environment, fixed income should be the best performing asset class, along with gold and the US dollar. Industrials materials should be among the worst. Places to hide have been consumer staples and utilities. Those, quote, safe stocks that go down less than everything else. And the best fixed income sectors are long duration treasuries, medium duration treasuries. And you don't want to be in any leverage loans. And that's why a lot of the banks, and particularly the regional banks, have gotten into trouble in the last week or so. And that's been uncovered. And with that, I will turn it over to Wes. We'll take you through really what's happened in the market in the last week. And then we'll talk, I'll be interjecting my thoughts as well on some of the slides, but Wes will take you through the slide deck, and we hope that you find it informative.
All right, thank you. You could just turn, yes, those over. Oh. So yeah, well, first I just want to say we surpassed 2,000 members of the meetup, which is great. I think I was looking back, we probably added about 1,000 of you new members over the last year. So this has been great, and it's a timely. There's always something in the market. So happy to give kind of our take. And if you've been under a rock, you may have missed it, but Silicon Valley Bank. This is kind of like the headline Thursday. This chart shows them at 106. That's when they stopped trading on Friday, and then they ultimately went under. That was announced, I guess, Sunday, along with Signature Bank. And so, what we're looking at really is it's an issue with liquidity. It's not exactly a credit crisis at this point. It's just a liquidity issue. They have, in order to fund their deposits, they had to sell some U.S. Treasury bonds. These, just given the rate environment, given the huge increase in interest rates over the last year and a half, they had to sell these bonds at a loss to find liquid cash to give their depositors their money when they needed it. So I think they announced this maybe Wednesday night or Thursday morning, and they were going to have to, they disclosed a $2 billion loss on the sale of $20 billion of bonds, and needed to issue some equity as well. And so, the market clearly didn't appreciate that kind of news, and basically, the bank run ensued from there, and there was really no looking back when the panic hit. Some of the things that are unique about Silicon Valley Bank, they had this longer sort of duration risk on their balance sheet with U.S. Treasuries. And their client base, that's really what people have been talking about. They have these profitless tech companies, all these companies that are backed by VCs. So, they're cash burning companies, and especially now with the economy, the economy's been slowing for a year, and credit conditions and I guess the ability to raise money has really contracted. So it's not like these profitless companies are getting very many cash injections from different investors now. So it's a combination of those things why they were really the first to go, and first to have these significant issues. Signature Bank of New York, I know that they're grouped in with a number of other banks too, and this one was closed down on Sunday as well. I don't know as much about who their clients are or anything, but I believe they had some crypto exposure, and so things like that. But I mean, nothing really to add there. But here's a table that someone put together. LPL Research has put this together just to give you an idea of the size of these banks, and a lot of people have been talking about these unrealized gains and losses. That's kind of the hot topic, just because on your balance sheet as a bank, apparently if you have a held to maturity asset, you don't have to show that loss on your income statement, even though these bonds obviously would be sold at a loss, given how much interest rates have risen over the last year. So I believe they disclose these kind of things in a footnote. And again, there is no problem really, because there's not a credit risk in U.S. Treasuries. If you can hold it to maturity, then you have no problem. Clearly, there was something, their client base basically forced them to have to sell some of these, maybe I guess almost all of these treasuries, and realize those losses. And so that kind of shocked the market, and set off the dominoes of a number of other regional banks that might be having issues too.
Wes, let me make a point right here.
Okay.
And that is, guys, what happened with SIVB Financial Bank Corp is they had for most of their deposits they borrowed all this money. Depositors gave them all this money, and they put it in long duration bonds. And as interest rates have risen from essentially 0 to 5%, 4 to 5%, over the last year and a half, they've lost money on that part of the bond portfolio. And now they're not alone in doing that, but the mistake is taking short-term assets and matching them with long-term assets. What they should have done is taken those short-term deposits and invested them in short-term bonds, not long-term in that particular case. And since we've had the largest rate of change that's ever taken place in the bond market, the worst bond market in history last year, and they're upside down on their positions. Now the Fed came out, FDIC came out and initiated what's called a bank term funding program, which allows all these banks that are showing unrealized losses on their bond portfolio, they're allowing them to be utilized as collateral at par. That's 100%. So, and they're able to do that for up to another year. So what the FDIC is doing essentially is kicking the can down the road. So there's not going to be any depositor risk. Your deposits at any of these banks, any FDIC bank, they're going to be essentially insured, even if you go over the 250,000 minimum. So there's really no chance that you'll lose your money that's deposited in these banks, which is much different from the great financial crisis that we went through in 2008. However, you still have equity risk. It doesn't mean that these companies, the equity and the bondholders would lose everything if the bank goes under. So you have to make sure, of course, that the bank is solid. But I think that's going to alleviate a lot of the concern that just took place what the FDIC did not in an alarming fashion in the course of one day. So remember, SIVB went under in one day, and Signature Bank went under. They closed that bank on Sunday as well. So you could expect more fireworks because a lot of these smaller banks, particularly in the regionals, have lost so much money, and their tier one capital ratios are at risk, and they're just weaker institutions. But companies like Charles Schwab, for example, and Fidelity really don't have any risk, we think, at all. Fidelity, for example, is a $7.4 trillion company, twice as big as JP Morgan and Bank of America combined, and almost including Wells Fargo. And their assets and securities are separate from the banking aspect. They've got $400 billion in the bank, and of that, 10% is for loans, and the rest are in short-term securities with the 3-year duration. As long as you hold those to maturity, you cannot lose money. So don't think that Fidelity or Charles Schwab or any of those large security companies are at risk with your investments. So I just wanted to point that out.
Great, and that does answer someone's question in the chat who was asking. I'm sure it's a common question, and I think you made a good point about matching duration, right? I mean, we don't run banks, but that makes a lot of sense. You should be matching the duration of your assets with your liabilities. I mean, typically they borrow short and lend long. And they didn't necessarily do that here. They borrowed long and kind of lended short. So not the typical behavior. And yeah, you mentioned how maybe more fireworks, right? It kicks the can down the road for a year because of this new lending facility where you absolutely can have your deposits funded, right? They will take out that loan and give you your deposits back if need be. But the panic seen at these banks, right? A lot of them in the West Coast, that maybe have similar client bases, is still there. Bottom fishing is dangerous. These stocks can still go to zero, because it's unclear if just plugging the deposit hole with a loan is going to help these guys survive. They're going to have to really do some, they're going to have to put out some fires with some clients of theirs. and we just hope that it doesn't cause more instability. So you just it's very dangerous, right, to try to pick a bottom here in some of these things. I'm trying to think if there's anything else to add on the program. I mean, I think the most interesting thing about it is that they told you that it's only going to be for a year. To me, I think that means that they expect to be cutting rates also within the next year. Because as you cut rates, that will alleviate also the balance sheet issues that they're having with the losses from these securities. So I think that they plan on cutting rates already, and that they and that's why they feel comfortable saying you only need this loan for a year. So that should help maintain some of the equity, if as long as these banks can hold on to their depositors. Okay, and in lesser news, for the first time ever, or for the first time in the last year and a half, the CPI was another thing that happened today. It continued to slow on a year-over-year basis. I think it was up 0.4% month over month, maybe. But continues to slow from the peak back in June to 6.0%. Comps are still going to get easier and easier for the next 4 or 5 months. So you should expect this to come down. Not to mention, you got to think that this bank instability is certainly going to be deflationary as well. So that, alongside with where we are with with the current Fed funds rate, probably I think enough to get us to 2%, but we're also clearly teetering on this significant recession risk as well. So great CPI is coming down. Make sure you're keeping your eye on the recession risk as well. So that really would be the more important thing, right? Once we realize inflation is coming down and it's because of a potentially a recession, that's really the key driver to think about. And the market doesn't bottom, or hasn't bottomed in the past, until we were in the middle of a recession. So we might be entering that on starting Friday. It could have been day one of the real recession, potentially, just given the bank action, right? Who knows what the conversations are right now, but people will be tightening their belts, most likely, and just pausing all activity for the near future, right, as you assess what's really happening in the world. And so with that, this is the look at the Fed's probability of different rate hikes next week at their meeting. If you were to look at this chart, I'll just show you the next chart, but there's an 80% chance now that they just do 25 basis points, 20% chance that they do 0. I have an opinion that they shouldn't do any more. I think that financial stability should be on the top of their mind, and clearly we're already in restrictive territory, so there's really no need, I don't think, to go, but we'll see what they decide. But the market's telling you already that there will be cuts. They don't necessarily think cuts are coming next week, but shortly thereafter. And this is a chart that I think is interesting. First of all, they've extended the meetings out from the CME future, so you can kind of see the probable Fed funds rate as far as May 2024 now, at 3.64%. And so look, just 1 week ago, this red curve is showing the expectations of all the meetings just a week ago. So you think about the dramatic change, right? This was when Powell was on TV 2 straight days, in front of Congress, and he was basically talking up the curve, and saying that we're going to be there higher for longer. Well, what a week makes is now we're down 5.5% to 4% within the next 6 months. So quite the change, right? And we've been talking about this too before, like, you're going to see rate cuts, and that's not going to be bullish, right? That's what the concern is. When the Fed starts hiking rates, they're too late. And so we've been sort of talking about that, and it's been unclear whether we'd have this any kind of real credit event, but it looks like we have one. And so this isn't necessarily bullish, in itself, just because we don't know what the economy does. But this, is the action that will set the stage for the next bull market. So it's, it is important to note. Okay, and then this is another chart. We're looking at the 2-year yield versus the Fed funds rate. The Fed funds rate's in red, where the 2-year yield is in black. And so typically, we're looking at this as if the 2-year yield is telling the Fed, they're front running the Fed, right? They're baking in the cuts already. You can see the 2-year yield on the way up completely led the Fed funds rate all the way up. And right here, just cutting through sharply, right? That's down 100 basis points in just a few days, from 5% to 4% on the 2-year yield. So this is the market saying, the Fed, it should and is going to cut. So again, I don't see the point of doing 25 basis points just to reverse it like the next month. But who knows? They've proven themselves, somewhat incompetent at this. So. Okay,
So
and then here
let me just
point
out one thing. And because of this, you can notice this just took place over the last 4 days. So we were wondering if we were going to have one more move up in rates, and we got it based on Powell's very hawkish comments. However, something broke. And so something broke, telling you that they had to do the most dramatic overhaul in the FDIC in history by guaranteeing all deposits for all banks in our country. And so we think that that's setting the stage for lower rates. And we think that the 2-year, the 2 years peaked. And we also believe that Wes will be talking about the 10-year in the same scenario. And we think bonds are extremely attractive now, particularly in the intermediate to medium duration and long-term part of the curve.
Yep. And I was just looking at the chat too. I see, Yogesh highly doubt they bring down rates. I mean, this is the best information we have. The market telling us that it is going to happen. And I hear you. I know that it seems like, I think it would be incorrect for the market to think that cutting rates will be inflationary. I think that overall the the banking conditions, and with 2 banks going under and risk of more banks going under, I think that is so deflationary in itself that cutting rates is not going to be is not necessarily going to prolong the inflation situation, but we'll see. And the yield curve, this was at a ridiculously low inversion, right, where it was about 100 basis points inverted, the 2-year minus the 10-year, and that's been one of these well-known, highly back-tested leading indicators of a recession. And as the market rallies, of course, everyone's considering, okay, maybe we don't have to have a recession, maybe there can be a soft landing, et cetera, all that. But this has continued to signal a recession. So a big change in the inversion with the 2-year coming down as dramatically as it did. So this should continue to kind of reverse course if the Fed does change policy, if and when they do change their policy. We'll see this inversion turn around, and then that'll kind of that'll correct the lending environment for banks who want to again borrow on the short end and lend on the long end. So that should encourage more credit creation when that inversion does happen, or uninversion. All right, and this is just a look at the long-term 10-year Treasury yield. Roy just talked about how, we are looking at long-term bonds just because this is with this massive move in rates to the upside and risk of recession and, inflation coming down, there's the scenario where this just corrects to a longer term average, corrects to this. We're looking at this, maybe this 2.6% area, which is 1 percentage point down from where we closed today on the 10-year yield. That could be support on the chart here. And so, if that were to occur in the 10-year treasury, that's roughly 10% upside on your principal from that move. But Roy, did you want to add anything here?
Yeah, Wes, I wanted to point out duration. And duration, it's a mathematical relationship, really sort of a weighted average return of how long the bonds are out there. For every 1%, for every 1% drop in interest rates, you're going to have a subsequent percentage increase in appreciation. For example, with the long-term bond with the 10-year duration, for every 1% drop in rates from here 3.6 to 2.6, you're going to make 10% in bonds. Plus, you'll be getting a coupon, and the coupon on the 10-year is maybe 3.5%. Well, there it is, 3.64%.
Yeah.
So if you get a 1% drop, and we think that you probably have, depending on if we go into a recession, which is quite likely, we think you might have a 1.5% drop in rates based on the Fed expectations and based on Fed funds futures and based on where we are. So we don't think that long-term bonds represent much risk now. Of course, the reason that these other banks went under is because rates were zero, and now they've gone from zero all the way to 4.2. We think we're on the other side of this turn, and even if you go sideways here for 6 months, 9 months, then we think eventually rates are going to roll over, and we think their bonds are very attractive here.
Roy, quick question.
Yes.
If you don't want to buy individual bonds, can you play the same strategy, just getting the TLT, looking for?
We are. Yeah, Michael, we're actually in the IEF, and Wes has that coming up. That's the 5 to 7 year duration. And we also have the TLT, which is a 20-year duration. So those are among the largest ETFs in the country. And that's how we're doing it. It's much easier buying that ETF than a number of individual bonds, so that's why we're doing it that way.
Okay, good, thanks.
Yep, and so yeah, we'll just go through them. You can write these down if you have any interest in looking at these. We'll go through kind of quickly because they're all very similar. They just differ in duration. The IEF here, this is the 7 to 10 year duration bond. So you're gonna have some upside here if rates do correct, right? We talked like 10%, maybe, right? So 97, let's say, to 107. If rates do come down, and then you get that coupon alongside it. This TLH is then a little bit longer in duration, so it's 10 to 20 years. I don't know what the actual, it's somewhere in that range, right? But if you look at the fund's information, they'll give you the actual duration. So you'll have maybe 15% upside with a 1% drop in rate. And then the TLT is the 20+ year ETF. So the most upside for any kind of decline in interest rates. And, this is what happened last year, right? As rates rose, the TLT was down 35-40% or something. So, that's what you have to deal with too. So just be aware of that. It's not like you're buying, it's not, it is I guess a risk, it's the underlying is risk-free. Just be aware that, this moves quite a bit depending on where rates go.
So just to point out, so if this if rates drop 1% in the 20-year, this is going to move up 20%, plus you'll get the coupon. And I think that's quite likely over the course of the year, not over 3 months, 1 month, 4 months, 5 months. Over the course of the year, we think it'll make that type of move. So we have advocated strongly against having, quote, a 60-40 asset allocation mix because bonds have been in a steep downtrend and you've lost money. Now we think it's flip-flop, and no better time to do that than take advantage when the bond market is panicking and people are, when people are blowing up. We think it's an ideal time to buy bonds at this level, not before. And we've been on record for the last 2 years to avoid them until like right now. We think that they're as attractive or even more attractive than stocks as the stock market tries to work its way through this volatility.
Yeah, and so just also, by the way, everything we're showing is actually iShares, so it's a BlackRock fund. Fees are real low, and they're like the biggest, they're the biggest provider of ETFs. So, that's why we kind of preferred them. This is what we've been into. I mean, it's what's interesting about this T-flow and SHV, zero duration risk, basically. But you're also, you get zero duration upside. These have been, these are paying 4.5% to 5% right now. But when the Fed does pivot and starts cutting, these are going to stop going up in a straight line, right? These are going to flatten out because they're so short term. They're really influenced by what the Fed does. So for now, they're okay, but just have to keep that in mind and kind of get ahead of what the Fed is going to do, because these you don't want to when T-flow, if that goes to zero, there's no 0 point of holding it at all. But for now, again, we've been holding it here. Mm-hmm.
We view this as just a better than a money market fund or a checking account. We think, and it's very close, and it's made, both of these are 100% treasuries.
Yep. It would be much better if our money market account would pay what T-flow pays. This is zero duration overnight, rates tied to the U.S. Treasury market. But there aren't, not every brokerage is offering a good yielding money market. So this is what we've opted into. All right, so we'll go through the last half of these charts. A little more quickly probably, but it's just our regular charts we're always looking at every month. This is the S&P 500. I'm showing this downward trending line that, come January or February, we were really, breaking this downtrend line, right? And we had this, all those momentum indicators, breakaway momentum. We had, a lot of buying power these couple of days here. And then a tough reversal. So now, we just poked our head below that trend line again yesterday, the last 2 days, and a lot of things have changed following, the sort of our more bullish stance in February. A lot of things have changed. We hit support a couple times, but and bounced where we should have bounced. But new news hit the market, and now we're just dealing with that, with the trend change. And we're really in a short-term downtrend now, with the green line, the 10-day moving average below the magenta 21-day moving average, and now we're below the 50-day, we're below the 200-day. It's not, it's obviously not a time where we want to get aggressive, and you might just want to sell bounces into resistance at this point. This is the NASDAQ and the MACD. The MACD is still on a sell signal. The MACD sell signal occurred back here, maybe February 13th. So really, a pretty timely indicator right there as momentum waned. You wanted to see how the NASDAQ would work through its overbought condition, right? We're overbought here February 2nd. When we peaked most recently, and here's a downward trend line where we're kind of thinking, maybe we get one more day up, one more, bounce, right? We were super oversold here. We'll show the McClellan oscillator, for example, which we like to look at to show us how oversold and overbought we are, but we might get one more day up. We closed at the high today, which was pretty wild. If you look at the intraday chart, it looks like everyone got stopped out, and then the market took off in 20 minutes to close at the high. But this is sort of where we're looking for this bounce to take us potentially. Just another day like today would get us there. NASDAQ in volume, I guess not a lot to add here. We've seen these pick up in distribution days, with this.
Wes, take a look at the golden cross there. See, guys, if that is a notable bottom that we had yesterday on that key reversal yesterday, where everyone got faked out, and dramatic news by the FDIC and the Fed and so forth. You've got the yellow line about to cross the red line, and that's called a golden cross, where the 50-day is crossing the 200. So we just need a little bit more time. It's possible that we're still putting in the bottoming action here. That's possible, but we don't think the market's going to take off based on what's transpired, in the last few days. But you hear that old term, backing and filling, bottoming process, and we'll know this after the fact. No one has a crystal ball. We just have to look at the evidence that's presented in front of us. We do know that that green line is below the magenta line, so we're in a short-term downtrend. And we viewed the pullback as viable. Now we're not so sure, and consequently for us, we've really cut back our stock exposure. I think we have 8 stocks and a 20% portfolio. We're not saying that's for everyone. We just think that based on our indecisiveness and with the market and the potential lack of a lot of stocks that are setting up, we think you should be under invested in equities right now until the market environment improves.
All right, thanks. And yeah, well, I'll pull this one up too. We look at this for the trend, but we were talking like we're not going to be overly bearish here, not overly bullish. Clearly, we don't want to add like exposure, given the the uncertainty. But it doesn't appear like it's a 0809 type of a crisis, right? It's a liquidity issue, and I mean, for now, that's what it is. It's a liquidity issue, and that might be it, right? And it might just be 2 banks go under, and then the government backstops all deposits, and the panic can stop. But the trend is weakening. We know that, and so it's we need to let it resolve itself. On a longer term basis, we always look at the 30-week moving average, this yellow line here. We don't want to see it close. The NASDAQ closed 2 days below that 30-week moving average. So far, we're on track to close above it. It's been 2 days this week, but we're back above it after falling below it last week. So, there's not a violation, I guess, on this for the longer term trend. And here's the S&P 500 with the stocks above their 50-day moving averages. But we still have a little bit of room to get more oversold. The last few times we put in a really good low, the stocks above their 50-day moving averages dropped to somewhere like 10%. So we're sitting at 24%. We're close. We're definitely close. And I think this has a pretty good track record of saying hey, a lot of risk has been priced in when we get to that kind of level. So keep an eye on that. The 200-day doesn't show as much, I don't think, clarity, but it's a slower moving type of overbought, oversold oscillator here. So I don't know, nothing from, I don't think really stands out here. The NASDAQ now, if we look at that and their stocks above the 50-day moving average, similar story as the S&P 500. The S&P actually, has shown itself to be the weaker index in this pullback, I guess, with the bank exposure. But same story here, where we've got this, we've got a little potential to go a little bit lower, right? Get closer to that 10% of stocks above the 50-day. And it's possible we get there, and look, we just go sideways at the bottom. We continue to just to work on finding the bottom here.
And Les, let me point out, guys, also, so for those that are novice investors, novice traders, and so forth, rarely in our methodology, in terms of what we're looking for stocks making new highs in price. And we're not looking to buy stocks in downtrends or when they're at their lowest price. We're looking for the stocks that hold up the best in a market correction. So this is simply showing you that 75% of all stocks on the NASDAQ aren't buyable, really. So that's the kind of environment that we're in. You can see the ups and downs that have taken place in the last year, the last year and a half. So that's what happens as we transition from a bear market to a new bull market. So you want to see more and more stocks participate. And if we get down there to the 10% level or lower, you're going to want to pay attention to that 10% of stocks that are above their 50-day, because those are the ones that are going to shoot out the cannon like a cannon when the market correction is over. So keep that in mind. Buy the strongest stocks, not the weakest stocks.
That's right. Yep. And we have a small list, now that we'll hopefully we'll get to after this portion. All right. And so this is something that we, noticed the last couple of days, which is a little concerning, right? There's this big pickup in lows, new lows. So we've got the new highs in the black bar chart and the new lows in this red chart. And so new lows again outpacing new highs to a pretty large degree. And you'll notice, when we hit that Walter Deemer momentum thrust we talked about last month, which happened in January, the real driver of that ends up being the new lows, right? Because you just see so few new lows for an extended period of time, and that's really what gives you that momentum thrust signal that we talked about. But concerning to see that. It's not what you want to, that's not the environment we have. This is where we started to see the traction, right? Where you saw at the beginning of the year, new highs outpacing new lows. But this reversal, was a little disappointing. Here's a look longer term. I think, again, it provides good context of what we've seen this past year and how persistently new lows have outpaced new highs. Something that you could point out throughout the last through 2022 was really these major net new low numbers were shrinking on each downward thrust in the market. You would get a little bit better, I guess, relatively better. And this now outpacing what we saw at the end of December when the NASDAQ was bottoming is something to be aware of. Okay, here's one of our preferred overbought, oversold oscillators, McClellan oscillator. This was at the close yesterday, extremely oversold, and that's why we got that bounce. We got a pretty good bounce the last couple of days too. It's still really not, haven't really resolved that oversold condition based on this yet. That's why we think, you could get one more day of a bounce. you know, to potentially sell into if you haven't lowered your exposure yet. Okay, we got a VIX spike the last few days too, hit just above 30. We've seen 30 a number of times the last couple of years. So not like a massively extreme number here, massive reading, but if we look longer term, you know, we'll go back and again revisit. We'd like to see something bigger, right? We'd like to see. We've been saying, you know, panic. We're like we'd like to buy panic, and just haven't really seen it in this bear market. No capitulation moment based on this. So still monitoring that. It's still, you know, when you're above 20, right? We were below 20 for the first couple months. You actually can buy stocks and hold on to them and not get shaken out. Now we're back in that 20 to 30 range. It's going to be tough. So, yeah, it's hard. It doesn't really give you much of a directional outlook when you're in that 20 to 30 range. We talked about the active manager exposure, I think, in the first couple of slides. This is one of the sentiment things we look at. This shows us net long exposure for active fund managers. It's sitting at about 60%. This was updated last Thursday. So, you know, given the action, I'm assuming this has come down a lot. This has also been, I think it's a pretty good sentiment indicator to know when people are overly bearish. Back in September and October, we were kind of that 10, we hit that 10% range the last, looks like the last week or so of September. So, you know, we'll have to see where that goes next week. But just, you know, this is just another thing we monitor for sentiment. We'll look at the AAII bull bear sentiment here too, with the bulls at 25% and the bears at 42%. You know, this was something I remember looking at in February, seeing the big increase in bears again. You know, that's kind of a positive sign. You saw these things kind of converging, the market hitting support levels, all while bearish sentiment picked up pretty quickly again. But you know, since again, this is maybe a week old too, but we're sitting here at 42% of bears and 25% of bulls, and that net number being 17% towards the bears. And in bear markets, it's just not uncommon to see bears outpace bulls for a very long time. So this is why, you know, it's not the timing tool that you really that you can really hang your hat on, but you know, at extreme levels, you have to take notice. We're not at an extreme level right now, you know, despite banking issues, but maybe that's the government's intervention, you know, being you know, actually being viewed favorably. Okay, and then we'll look at the put call ratio. This is the ratio of puts traded to calls traded, and so, you know, the higher the number, the more pessimism there is in the market. This is updated as of yesterday's close, so not today's close, but we have the 3 real spikes there highlighted for good lows in the indexes too. If I were to have the NASDAQ up here, that's where the NASDAQ was actually making a low. The S&P had outperformed at that point, so this was actually, I think, you know, the low in the NASDAQ December 28th when this thing spiked. We saw it pick up a good amount towards the end of February during that pullback. You know, and this is just, again, another thing to keep in mind when you're looking for a tradable bottom. This is a similar look. It's just the equity put call ratio, so not all exchanges, not showing panic either, not showing a real, I mean, it's a little bit elevated, sure. But another sentiment indicator that you guys can take a look at on your own too. Okay, and then, you know, a real interesting development is this credit risk that's accelerated to the upside in the last 4 days. So this is a look at credit spreads, which is, you know, the perceived risk that you see in the credit market. So that spread increased from 4% to 5% over the last few days. which tells you that there's a little bit of a risk off attitude right now, and there's just uncertainty, right? There's uncertainty about contagion. There's uncertainty about more bank issues. There's and it's certainly possible that we see more issues pop up with the rate environment being the way it has been for so long. Okay, I did throw this in here because I think this is wild, and I think that it's something to pay attention to. This is not at all how I would have expected Bitcoin to act. Given the financial stress of the banking sector, you would think risk off, but Bitcoin exploded to the upside following all of that news. And I don't really know what to make of it. I'm sure we can all speculate and talk about it, but I just feel like it can't be ignored. The move right there, is the strongest thing out there right now that you could have bought with the news of financial stress. So had to highlight this because I don't know what's going on. I don't know why, but it's a pretty incredible price action.
Wes?
Yeah.
Some of the chatter I've found is that, and it's probably irrational, but people are just losing faith in traditional banking and paper fiat, and they know that crypto is the future, and this is just sort of another argument. This incident's another feather in their pocket that they're right. So that's what I think is going on.
Yeah,
it'll drop back down to 20,000. It's going from 20 to 25,000. It's great trading range. But I think that's what happened in the past.
And I can appreciate that, but at the same time, it's like, how do I buy it and have faith that Coinbase is going to be okay too, or anybody? Like, why is Coinbase going to be in better shape than than JP Morgan or whatever to handle? I don't know. So
you don't have to keep it at Coinbase though. You can keep it off chain, and then it's really safe.
Isn't that complex? Like, it's not very user friendly still, right?
Yeah, it is definitely a tech thing, but you can pick it up. Maybe your dad can't.
Yeah.
I'm not that bad in tech.
Yeah. That's it. I mean, that's all we got right now, or with those.
Okay, we'll open the floor, guys. We'll open the floor for any comments that you might have, any questions that you might have with the market, and then we'll head on to the stock part of the presentation. Also wanted you guys to be aware, Gary Burgess, I got a call from his wife today. He's a longtime participant in our group. He's attended every meeting for the last 2 years, and he had to go to the hospital. I don't know the extent, but I don't think it's very good. So keep him in your prayers, please. Neil, what do you think about the market? Tell us kind of sort of what you're doing. How are you navigating through here? Let's just get some feedback from some of our more experienced investors.
Okay, yeah, I finally got unmuted. I've been having computer problems, so anyway, but I think I finally gotten beyond that. I've been sitting in treasuries, to be honest with you, mostly short-term T-bills and some very maybe 2-3 year treasury bonds. I'm about still about 40% invested, about 60% in cash, but I'm in a little bit of an unusual situation because of the cost basis I've got in some stocks and everything. So it's been reasonably well. I've survived through the ups and downs, but I've been mostly in cash and just doing short-term T-bills and those type of things. And as they mature, I roll them out, and that gives me cash available coming in case the market does turn. And if you do stay in T-bills, they're so liquid, you can sell them and get your cash out of them if you need it. So, it's just an alternative to money markets. And, there's no North Carolina state tax on the T-bill interest and everything. And so you can get a little more than a money market's paying and everything. But other than that, it's been an unexciting few months and everything.
What would it take for you to get more bullish? How would you move more money into the equity market, Neil? Or when would you take money? When would you have to cut back from your 40% position?
Well, what I've been trying to do is identify a couple of good companies that I think are trying to turn, and I've put, very small starter positions in those. And if they pan out, then, I add a little bit to it and everything. I mean, I did Boeing, I did HubSpot. Let's see, if there's anything else I did. I did Crocs, and Crocs is on the borderline. I'm about to kick that out, but, those type of things. I did a little bit in Meta. Meta's gone up 60% this year to date. And everything. It looks like some of the big cap stocks are trying to come back. I don't know the real reason behind it and everything, but that's sort of what I'm doing. Is I've got my core positions that I trade around. It's only 5 positions, and then I try a few starter positions. And I mean, when I say starter, I mean it's minute money until I see it's going to do something. And if it does, I mean, I did Nike. I mean, I'm up in Nike, I'm up in Boeing, and I'm up in most of the starter positions, but that's really about it. I've been more focused on bonds and everything. And then if I had any bonds that were underwater, like last year, I would do a bond swap. I would, sell that and then buy a low coupon bond that would mature sooner, and I could get to principal back sooner and those type of things. So I just been doing some tax type trading and small positioning and holding around. I mean, NVIDIA's been had a great run for me since, the first of the year. It's done very well. And so they sort of offset I've sort of stayed flat to up since the first of the year. And it's been because of the core positions I've had and the small, short-term positions I've been trying to establish and everything. So I'm trying to get ahead of the game with a very small, if I get a little bit in it, I'll watch it. And sort of a David Ryan viewpoint that if I've got a small position in it, then I'll track it. If I don't, I tend to forget about it. There's just so much noise out there. It's you just can't keep up with it all.
Are those 1% to 2% positions, and do you have stops on these small positions as well?
Well, I put in such a small amount, Roy, in relationship to the portfolio that if it were to go to 0, it wouldn't affect my portfolio that much. So that's sort of the way. I mean, it's probably 0.5% or 0.25%. I just want to get a position so that I'll watch the stock and it looks like, I look at the formations that have bottomed and the stocks have popped up above their 200-day moving average and sometimes 50-day moving average that have good fundamentals and so forth. And so that's sort of how I've been playing it. But I've been mostly focused on bonds and the treasury side of it because
Thank you, Neil.
it's so liquid.
How about you, Joseph? What are you doing these days?
Right now, I'm 100% in cash. I'm kind of, a shorter term trader. I was up 17% year to date. I had a great January and then went from 17% down to 6%. And I said, I've seen enough. I've had some, I was in AEHR. I had a third position that left and I got shook out on that crazy day after the Tesla Investors Day. And And I had Tesla as well, and I was trying to hold that, but when it broke 190, I think last week, I said I've seen this before, and let me just cut it. And now, I mean, last month I thought we were in a new bull based on the breadth thrust and stuff. I know the macro was bad, but all the technicals were screaming bull market to me. But now with all this funny business going on with the banks, I mean, they're trading basically like penny stocks the past 2 days. They're one day down 50%, next day up 50%. I mean, I don't really, I'm just going to wait for the technicals to change. And right now, along with the banks, I don't got a good feeling about the market right now. So I'll just be patient on the sideline and monitor some relative strength until it's time to put money to work.
Thank you, Joseph. And I haven't seen Bill Will's picture. Bill Will, are you online with us tonight? Yes, he is. Bill, we'd love to hear your comments. Bill is our most accomplished investor at, I think, 91 years old. And he's always got great wisdom to share with the group. And you'll need to unmute, Bill. And if you'll just hit your unmute button, we don't hear you yet. And you're still, there you go.
Can you hear me now?
We can hear you now, Bill. Thanks very much. What's your take on the market these days, Bill?
It's pretty much the same as the previous comments by the previous person on the program. I've forgotten his name, but I'm running about 50% in positions that I have already sold off a lot, but I've held some of them because of my real low tax basis. I have held some defensive stocks like Coca-Cola, which have made me some money during this bear market. But essentially, I'm in cash. But I express cash only one way, and that's 91-day treasury bills, which I've been rolling now pretty much for 2 or 3 years. 3 years ago, I decided to liquidate most all of my hedge funds, which I did. And I put all that cash in the 91-day bills, and I buy the bills because I don't want to buy bonds. I hate bonds, and I don't want to play the bond market. I just want to have cash expressed with treasury bills. And they can be sold, and I can subscribe through my account at Morgan Stanley, and get them in big chunks. And I like the previous speaker, I like to take a small position, 1%, 2% in a few things, and use stops to get out of them if they don't work. So I don't have any new positions that I am trying to take a look at some leaps on some great stocks that are big cap stocks that have really been beat up. And if people have given up on them, but their charts are beginning to look better. I was looking the other day at one called Eli Lilly, 2-year leaps. Eli Lilly is a company who I know has got a massive product cycle coming starting next year, and they're building plants in North Carolina, in Raleigh, Durham, as well as in Cabarrus County to make these products. And I think that's a company that stock could double in the next 3 or 4 years. And I'm buying 2-year leaps on that one, just to kind of get my feet wet and take it out for a date. And if it starts setting up right, which it hadn't yet, by the way, then I would probably start buying the stock itself after. But the leaps kind of keep me involved. I can't keep my eye on it, and didn't cost me much money. But when I hear these good ideas, sometimes I'm early, so I don't take big positions until they start setting up for the right kind of chart that I want to buy the breakout on. So, and right now, this is a tough market, and I just don't want to fight the tape. Tape's telling me it's just too hard to make money out there, and things are. And I want to wait till it's a little bit easier before I put a lot of leverage on my account. I've always used margin, but I haven't been a margin in 3 years. So right now, I'm just trying to stay loose and keep my capital intact. And like last year, I was down 4 or 5%, which I tolerated fine. And this year, I'm probably flat to up 2%, depending on what day it is now. So it's not, we're not making any money right now. So I'm a little, but I'm not going to force it. I never have. I just let the market tell me what to do, and it hadn't told me yet. So that's my story for tonight.
And Bill, one question, and then we'll let you go. We'll let you slide there. Or, I mean, you've been through every bear market in the last 50 years.
Yeah.
Are you looking for like new merchandise, new companies? Are you looking to just buy older companies that are beaten up? What's sort of your posture coming out of this
I'm
market?
looking for new companies that have set up this. Not everybody knows the whole story on. That's ideal, what I'm looking for. And I would do like you do, Roy. I'd probably start with a 2 to 3% position. And if the stock starts moving, the volume picks up and the market gets better, I'll double that position. I like to own 10%.
Yeah.
Is a for me, you know.
Yeah.
I've got to be in pretty liquid stuff to do that. And sometimes I'll substitute it and use in the money calls too. We screened that.
Yeah, full position. I mean, for many of us, it's 10%, and we haven't had a 10%. We haven't had a 5% position in 2 years.
I'm the same boat. Yeah, yeah.
You know, so, and we were just getting stopped out of these 2 and 3% positions, but you know, it's better than having a 10% position, you know, losing 1% a trade. Who else would like to interject? We'll open the floor. Anyone else would like to give their insight in the market? We would appreciate it. If you've been through this before, what you're looking for. Yes, go ahead.
Roy, one final thing from Bill Will.
Yes.
I started investing in equities when I was about 25 years old because I had inherited a small amount of money and I didn't know anything about stocks were about. But luckily, I've been traded now through 14 bear markets, maybe 15.
Mm-hmm.
I've lived through all of them, and none of them have been fun, but they always bottom out at some point, and you just can't rush it. Those are my thoughts for tonight. Okay.
Boy, that's great wisdom. Thank you, Bill.
So I'd like to ask a macro question for not just you, Roy, but also for everyone else who just spoke. So was it SVB that was the catalyst? Because last meeting, the consensus was pretty bullish.
Yes.
So was it primarily just SVB? And before you answer, and before anyone else answers, even before SVB in the weeks prior, the price action was still bearish, actually. So I guess, yeah, so my primary question, was it just SVB and the collapse that turns the tone bearish, or was something else preceding that?
Well, what made us primarily bullish was we've been in this bear market, and the averages had turned up. You had crossovers. We actually had what's known as a power trend on the NASDAQ, and the market typically it comes back and digests some of the gains that have taken place. And when a situation like that, you buy the pullback, and it's perfectly normal. And you know, we covered that January 11th Walter Deemer buy signal that's occurred only 25 times in history, and it's only been wrong once, and that was in 1987, and it was only wrong by a couple of percent. And in every case, moving forward from that momentum signal, the market has been higher 3 months, 6 months, 9 months, and a year later. So it's very odd, very unusual that we had that buy signal, and then we came back and gave up the gain, and we've actually traded below that January 11th buy signal. That's very, very odd. So, you know, it just shows you the danger of relying just on one indicator, one signal. But it was perfectly normal to pull back, and really, this could be a big shakeout as well. You know, this could be a big shakeout, but we need to see more stocks participating, and you need the new high list to expand, and that's going to tell you that the market environment is improving. So, you know, that's how we viewed it. But we were definitely more optimistic last meeting until this pullback and then the failure of the breakout.
Roy Paresh here, somewhat new to this group. couple of questions. One following up on the last gentleman who just mentioned. So yeah, since January, I think at the beginning of the January, market began to turn around. But that was more of a technical, as I understood it. Or did you guys see anything fundamentally change as market began to go high beginning of the January and most part of February? That's question one. And question two, what was the indicator that you mentioned?
Wes, do you want to answer that?
Yeah, yeah, the call was definitely technical. I mean, we follow Keith, who's been extremely bearish for, a year and 3 months. And so we know the macro picture from him. And, but there's no better economist than the market. I think someone, I don't know who said it, Druckenmiller maybe. So, we're going to follow the market more than our belief in what we think the economy is going to do. First and foremost, and I don't know, you said the indicator, right? Maybe it's the Walter Deemer momentum indicator. Is that what you meant, Paresh?
Yeah, that's what I was asking. Thank you.
Yeah, you can go to I think it's walterdeemer.com. Anyways, everyone was talking about this, and it is an interesting track record. If you go to walterdeemer.com, actually, you'll see every instance of it. And if you go back to our email from last month, you can pull up, the tables of that, yourself and see that marked on a chart, I think pretty well, which I think is interesting. And so, yeah, take a look at that. It's, it's just a breadth indicator that where you're most overbought at the beginning of a bull market, according to him. Yeah.
Thanks, Wes. Appreciate it.
Any other thoughts? Yeah, go ahead.
So I was gonna say, and also, I mean, personally, after the first month of January, I mean, I expected a pullback just because the indexes were up so much in 1 month, it just wasn't sustainable.
Yeah.
And I mean, to me, like the pullback in February, it was orderly at first. It just seemed like a normal pullback.
Yeah.
And then just this whole bank thing, but and like just personally, I just don't really like to trade like when the indexes are below the 21-day. If I can only have one moving average, it'd probably be that.
Right.
It's kind of where we're at right now, and this declining too. So just red flag.
Yeah, I agree about everything there. And we were looking at that key. It was like there was a confluence of things happening, and the pullback towards the end of February, where you're hitting all the averages you expected to, and certain price levels and all the indexes, and bearishness had picked up, and sentiment had gotten really poor. Right on time, and I totally agree.
What was the name of that indicator that you had mentioned that has such a great track record?
Yeah, we're talking about Walter Deemer still, and he somebody, sorry, I can't say their name, dropped the link to it. I'll drop it again in the chat, okay, there you go.
I just did. Thank you.
Yeah, thanks.
Do you guys know, so given that this was only wrong once? Or well,
yeah, and to say wrong, right? It was down 12. The market was down 12 months later, basically, is what we mean by wrong. And if you were to look at the table and the presentation from last month, you'll see what we mean. We looked at the 1 month, 3 month, 6 month, and 12-month returns following this instance. And maybe you were down a few times, maybe 3 months from the signal. 1 month, 1 month you were maybe down a couple times too. But 12 months out, you were only down once, and that was 1987. And not to mention, during 1987, you made a run up of maybe 30%. There's obviously a lot of days. I didn't go through the charts exactly of each signal, and it's obviously there's a lot of days in between the signal and the end of a year. So a year from now, we very well might be saying, yeah, we're up, but we know it's still an extremely challenging environment. With the Fed not on our back, and now with this new banking issue.
And just to point out just a couple of things also. Many of us Wes and I, we're subscribers to Mark Minervini and his service, and he's a friend of ours. And he's on a sell signal. He went to a sell signal Thursday after Thursday's close in his STEM model, stock trading environment model. He went to a sell signal. And he's also on a key sell signal for on his risk model as well, that has to do with number of stocks that are participating, new highs, new lows, breadth of the market, stock action, and so forth. And we think that's relevant here. It's just, he's not finding any stocks to buy either. And we know, we just know how challenging of a market environment it's been when the good stocks are getting stopped out. So with that, let's take a 5-minute break, and then we'll come back and we'll really look at the individual stocks, because we're trying to find the stocks that outperform what the market indexes are going to do. That's where the true leadership's going to come from, and we'll show you about 10 or 15 of those that we think are leading, that might be potential buys. So we'll come back at 8:36 and get started on the stock side.
Hey, Roy.
Yes, Joseph.
I was gonna ask you too about, I'm not a bank expert, but we talk about we want new merchandise, like in the IPO market. And I'm just thinking with this Silicon Valley Bank, since it was backed by so many VCs, that I'm wondering if we're even gonna get new companies that come public because of this whole mess. Like if it's gonna take longer for the IPO market to get going again.
Yes, someone's going to have to fund those companies. The FDIC reached out to twice to try to get a large investment firm to buy them, but there weren't any takers. And that's the problem. That's the credit risk, because you don't know what these private companies, venture capital firms are worth, especially if they don't have any revenues or earnings. So this was the go-to place for half the venture capital firms in our country. And this would have been alarming if you had 100,000 companies that couldn't make their payroll because SIVB went under on Friday. So the FDIC stopped that, or it would have turned into a 2008. So they're going to have to go somewhere, but it's certainly it's going to be difficult, I think, raising money for at least a short-term period, because this was the go-to place.
Actually, it just hit the news that HSBC bought out Silicon Valley Bank's UK brand.
Yes, that was in UK data. That's in the UK.
Yeah, so I think they'll find buyers. I mean, that they have the clout, but you've got a lot of private credit facilities that want to give them money, I'm thinking, and maybe that was some of the money that went into crypto was coming out of anything they could get out of the bank. They put there, because they're probably scrambling for banking relationships and can't go to First Republic anymore. And where else do you go?
Yeah, I wonder what happened. Kathy Wood had a venture cap. She launched a venture capital fund that's not trading. I wonder what happened to that.
And I'm glad you mentioned about the Schwab thing, because my broker, I have a Schwab and a TD Ameritrade, which TD is owned by Schwab. So when I saw Schwab going down a lot, I'm like, oh my goodness, I need to get my money out of here, because I'm not trying to, yeah.
You never know. You never know until the dust settles. But by the way, the CEO was on he was on the afternoon show. He was interviewed, and I came away very satisfied that there aren't going to be any problems. But there's contagion. There's the primary problem is with the regional banks. The small, mid-sized regional and community banks.
I'll just say maybe it's hubris, but it seems like the big banks, the Schwab, Fidelity, Morgans, and Chases are well capitalized. I work for Morgan Stanley, and internally, at least what they were talking about was it doesn't touch the big banks and big institutions.
Yeah.
I guess if anything, that's more business for you guys because people are gonna leave those regional banks and go to the big banks now.
It's setting up for more consolidation, don't you think, Dana?
Yeah, absolutely. Yeah, that was one of the takeaways. They had a big Monday morning powwow with everyone. That was one of those that it'll consolidate in that area. There might be some movement and alternatives and venture capital and things like that. There's a good article on Substack by Grit Capital, and it gives a spreadsheet of the situation that Silicon Valley Bank had, where they had so much of their portfolio in 5-year plus notes. And then it gives a breakdown of bank by bank by bank. And what caught me off guard was it looks like Bank of America has 22% out there, but it just says, okay, of the regional banks, who else could have an issue? But I don't think that's going to come to pass with the Fed backstopping.
Yeah, they're going to be, the fallout, it's going to be in all these banks like First Republic. I don't see this approaching the highs. Wes and I were talking about this. I think, I don't think this stock will hit a new high in price for 5 years, if ever. They're just broken now. They're broken. They're damaged, broken. They're down so much. Don't be consolidated by someone else, over the subsequent years.
People still want to play in them. It's like playing in traffic.
Mm-hmm. Yeah. Okay, so 8:37. Let's take a look at. I'll take a look at some of the leading stocks that are out there, and we all can share what we have. And we'll take just a brief look. And of course, these by no means are any recommendation to buy. We could be out. We're close to selling these stocks, depending on what happens with the market in the upcoming days. But we view a number of these that have all had great earnings reports, very strong. So this Airbnb, that earnings were up 500%. Of course, this was an IPO a few years ago, and what got our attention was the great. That 10%, 300% increase in volume, 10% increase in price that normally tells you that now the stock's ready to blast off and go and re-exert itself. And you can see where this stock has pulled back. It peaked up there at 144, pulled back to the 21-day, started to turn up. Everything's looking perfectly normal. And then we had the break in the last 4 days where the stock came down to the 50-day. And so, stock's in an uptrend. It's above the averages. Relative strength's 85. Great revenue growth. And they, in their earnings call, they had great forward-looking guidance. You can see earnings are going to be up 28% this year, 18% in 2024. And of course, this stock dominates what they do, and it's well known, an institutional favorite. But Wes and I were talking about we should be buying this buying a lot of these stocks if we felt like the market was going to turn. We just don't know how the market's going to turn. Dexcom is the continuous glucose monitor company that came out with a great earnings report. They're dominant at what they do. The stock started to take off, and then you had, I think it was a competition with, I think Medtronic or Merck or something like that dropped the stock back down. It's building a base. They had great earnings. Earnings were up 900% for the quarter. Great sequential revenue growth. And they just launched a new product a week ago where their product is covered by Medicare for type A and type B diabetes. But a competitor announced a new product, so that's got that stock under the weather right now. But well-known stock that's been dominant for many, many years, that we thought that the new product was going to launch the stock into new high territory. Global Foundries is a company that had 700% earnings growth this past quarter, 900% before, 900% before. Great revenue growth, and it's sort of a play of that the IRA, the Inflation Reduction Act, where the government is subsidizing semiconductor foundry companies so they can bring their business from China back home. So it's a play on that. You've got great revenue and earnings growth. The stock blasted off on the earnings report, and this is just showing you the market environment. The stock was showing great relative strength, breaking out, and then it came back into the base. So it's clearly being held back from the market. But you want to see, these are the kind of companies that you want to look at that have great fundamentals. It's just they may not work because the market environment might not be right. Lantheus Holdings, it's the medical imaging diagnostic company that's got the best product out there to identify prostate cancer. And they really had a tremendous report. We'd been in the stock before. It blasted off on the earnings and on the earnings report. And that's the type of action, see, guys, when you see on an earnings report, something dramatic has changed. And we've been doing that we've been identifying the leading stocks, those stocks that can double and triple over the course of a year or so for 3 decades. And when you look for stocks that gap up on the earnings, when there's big institutional support, that's telling you that, okay, these are the next new leaders. And they all have this type of pattern. Datadog did, Zoom did, Teladoc did, Livongo did. They all, Facebook, when it's after a year of its IPO, when they monetize their numbers, that broke out in a big way in 2017, and began to launch where it had a multi-year, triple-digit return. But this stock broke out, has consolidated beautifully, and it's got a price target of $120, I think, on the street. It's a $73 stock. This is exactly what you want to see leading stocks do: not give up much when the market is going down. So this is definitely, an institutional favorite. It just went sideways and got quiet. But I don't think it would be the stock, it's the market that is holding the stock down.
Roy, quick question.
Yes.
I see it's at stage 4. Is that a concern? Will it get back to stage 2 at some point? Is that a better buy point? Or
It's really not in a stage 4. Stage 4. Oh, the base.
Yeah.
Yeah. It's above the. I was thinking of Stan Weinstein's phase 1, phase 2, phase 3, and phase 4. That analysis, and that's looked at a little bit differently. So no, we don't think that. The way that Market Smith identifies their bases, we don't think that it's an issue.
Okay, thanks.
Las Vegas, oops, I hit LVS. So Las Vegas Sands, LV, where is it in my list?
It got there now, yeah.
There, okay. This is what you want to see, and this is what leaders look like. Look at the earnings report right here, and the stock blasted off, and it continued to go higher. See, this is in a favorable market environment. You look at those earnings reports, you look at where Wall Street raises the target, there's going to be some fundamental backstop. There's going to be a fundamental reason that stock is trading at a new high in price. And in this case, Las Vegas Sands, they've got 3 casinos in Macau, China, and one in, I think, Singapore, and one, maybe one in Rome. And they're opening, China is opening up their market. And so this is a company that was cash flow positive last year, but business was down 91%. And so if you have a company that's EBITDA positive in a bad market, just think what's going to happen when they really open up the market, and they're opening up China right now. So this company consequently is, it's consolidating near its new high. If the market environment improves, this stock would be a buy right here at the 50-day, and you would press it, taking out that 60 pivot, you'd press your position. But we can turn around 2 days. You can take out the low of 2 days ago and you get kicked out. So be aware of that. But you have to have your stop in right there to protect yourself, because if the market, it could go to 50, it could go to 45. But you have a great way of identifying your downside, and you also see you have a way of pyramiding your upside as well. So this is really what you want. You want stocks that go into new high territory, consolidate, and then make the next leg up, like a stair step period. But this company is going to have great earnings, from a loss last year to 2 big profits, in 2023 and 2024 over here on the earnings screen. And it's a good price, $42 billion market cap. And this is something that institutions would be buying. And look at the decline in volume, see, over the last 5 days. So the stock has pulled back on lower and lower and lower volume after, you had the initial move down right there. That's classic bullish action. Mercado Libre is like the Latin America eBay, if you will, eBay, Amazon, and they're in the internet retail business. It's a fairly large company, a $61 billion market cap. But what's gotten our attention are the earnings. The earnings, which is, the big A in CanSlim. Earnings are going to be up 68% this year, 49% next year. And see, as you try to identify these true market leaders, you want them to have, they typically average 8 consecutive quarters. And that's about, I think, 96 weeks, 13 weeks times 8, 94 weeks maybe. And so, a true market leader that goes up 100 to 200%, it's not going to do that in 13 weeks on one earnings cycle. You're going to need a new bull market, but you're going to have companies that continue to hit their numbers and raise guidance. And what we like about this company is the earnings. And this is the largest volume that it traded going back, largest volume since January on that big spike in the earnings report. And it broke out, came in, and it's just going sideways. And we, of course, own this stock as well. And I think we actually have added to it, but you have a great place to add at this 1251 area, taking out that high. So if the market improves, this is where you'd be wanting to take a position down here at the 50-day and then press it up there, taking out that 1251 pivot. And, you've got a nice 8-week base. Earnings were reported. Guidance is great. And that's a 97 relative strength, a composite rating of 99. That's, we clearly see this stock going to, 15 to 1600, in the next 6 months. Impinj is really a semiconductor company that makes RFID semiconductors. Smaller company, a $3.4 billion market cap with a 98 relative strength. But look at the earnings. Earnings have grown, and this is the really the humdinger. Earnings have grown 4 straight quarters, and they've accelerated 9 cents to 11 cents to 34 cents to 41 cents. Earnings were up 150%. So you've got triple digit earnings. You've got 50% revenue growth. And the models that Bill Neal has, that he used to determine where these great leading stocks came from, he was looking at stocks that had 25% earnings growth and 25% on a quarter to quarter basis and on an annualized basis as well. And Silicon Lab, SLAB, and Wes and I were talking about this. This is the earnings report. See, perfect action. This is, just perfect action. Blasting off, following through, but the market, the sell-off in February has brought it back down to the 50-day. And look at the earnings reports: 900%, 631%, 256%, and 70%. And you've got these great revenue growth. The stock's got a 93 relative strength, and there's the all-time high on the stock at 194. So these are the things, these are the types of companies that you would want to buy that should lead, in a new market uptrend. Here's ANET that made a new 52-week high today. So if you're finding stocks that are making 52-week highs, something truly extraordinary is going on. And this is a stock that's powering ahead, but it is very extended. So it's not coming out of a great base. It's gone, it corrected. The last time it made a 52-week high, it sold off 30%. You got kicked out, came all the way back, consolidated on this short, stubby base that's not really buyable, particularly when you look at what's going on in the backdrop with the market. And the last one I guess I'd like to go over is this super microcomputer that just made a new high 3 days ago with tremendous earnings growth. You can see earnings growth over here on the left side: 200%, 200%, 490, 270%. And the stock reversed on the earnings report. There was a short report that dropped the stock earlier where a company that said the stock had fraudulent statements, and that dropped the stock. And that's why the stock corrected from that 92 area to 69. But it looks like the shorts have been wrong so far, because the market knows better than what people say, and the stocks rebounded to all-time high territory. So those are just, and I guess the other two, the semiconductor stocks that have been leading have been the ALGM. That's on everybody's list. And notice where this stock broke out, see, after the earnings. And it's really got, that's in a bull market, you're going to have all these stocks. And we missed this because this was right when the February correction started, but this stock powered ahead. And now it's made a higher base, but this is, I guess this would be one of the leading stocks in the marketplace today. And they're primarily in the automotive, the EV area, industrial markets with their silicon carbide chips. And then ACLS is another. Satellite company Iridium, and you can see, and we actually stopped out of this stock right there the day before the earnings, because we didn't know what the earnings were going to be, and it didn't hold that 21-day. We had to take our loss, and you can see it bounced off the 50-day yesterday. But they got they signed a great partnership with Qualcomm, so that you can send text messages anywhere in the world. And that the market for that is just, it's astronomical. And That's a potential huge new market. So that's why, that's why that stock's been acting so well. So we'll open it up, guys. What stocks would you like to look at?
I had a general question.
Okay, go ahead.
Thank you so much. And by the way, great call tonight. So much good information. You had a guest a couple weeks ago. I can't remember his name. Very, very interesting guest. It was a great session. And he was extremely bullish on commodities, energy, and materials in particular. Very bullish on all those. And what I'm baffled by is in the beginning of your presentation, when you look at the macroeconomic analysis, if we are in quad 4, then absolutely the worst asset classes it's listing is commodities.
Yeah.
The worst equities are energy. And we just had oil hit a 52-week low. So what is your feedback regarding the guest and where we are right now with energy, materials, and commodities, some hitting bottoms, 52-week lows?
So Wes, I'll let you handle that, Wes. I'll pitch in. Go ahead.
Yeah. I mean that the quad asset class, that we showed early in the presentation, timing is everything for, in this whole situation, right? Like the dollar is supposed to be doing well. It did have a very good period of 2022 and then peaked in October and came in 10-15%, right? So it's not like it doesn't do well, month after month after month after month necessarily in any environment. Things go in and out of favor. You're right, oil should not do well in quad 4. I mean, I think that if we were to look at that from today, of course that hasn't worked, right? And if the recession does deepen, that's the case. I think that his main takeaway was to not necessarily even look at, we typically look for relative strength. That's where relative strength was 2 months ago. Things like Nucor, I know we were talking about those making new highs. What else? STLD, was making new highs. So that's what he's looking at, right? It's and I don't know. I guess oil stocks were near all-time highs. So if you're looking for relative strength, that's what your logical conclusion would be. And to us, it's confusing, right? We're all looking at the macro and considering that we might be going into recession and everything, but then you see the charts and you see all these things making new highs. It makes you question your macro view. And we're going to listen to the charts first and foremost, versus our opinion of what might happen to the economy. So I think that's generally what drew him and drew, I think, people to look at those stocks.
Well, I appreciate that. And I do see that, technically it's a balance between the fundamentals, the technical, and the macro. So just because the macro isn't aligned with quad 4, you do have the balancing out of the technicals and the fundamentals also.
You do. And like gold is another one that's been really tricky. For instance, throughout the entire last year, it's gone sideways and it's supposed to be one of the best performing things. And, even more glaring was, the bond market in 2022, right? The economy's slowing, inflation is slowing, and you can't make money in bonds either. So, clearly you just have to, first and foremost, you really do have to look at the charts. It helps to understand the macro to add conviction, helps to understand the fundamentals to add conviction, so you don't get shaken out on ordinary type of moves. But yeah, it's not been a proper quad 4, as Keith would call it. A proper quad 4 is all those things listed outperform, and all those things he also listed underperforming. That hasn't been the case. You know, oil had its separate dynamics, right? Where it's just persistently high oil prices means good cash flow generation, and it was a place to hide. So, you know, there's all these, you know, idiosyncrasies to 2022 in hindsight. So,
And
yeah.
Christian, let me just point out as well, John Roque, and he's a terrific, fantastic technician. He worked for Soros's group, and but he's not a macro guy. He's a purely technician. So he's looking at the technical aspect. And see, it's been it's been a difficult market to trade in, because from the quads, you saw that fixed income should have been your best performing group, and it hasn't been. And we've been in quad 4 for for I think the last 2 quarters. And so rates have, begrudgingly risen, and they're supposed to be going down, but we had the backdrop of what the Fed's trying to do. And, so we view that the quads and bonds trading now where they should trade, so we think now, after the last 4 days, that now you'll start to see bond yields go down in quad 4 as, we potentially move into a recessionary environment. And what's going to make this tricky is, you hear people talk on TV about a soft landing or a no landing, no recession. Well, I think we just saw in the last 4 days, if you think we're going to have a soft landing or a soft recession, you can call this a soft, the Fed's action just as a softball. And it certainly wasn't softball. It's the biggest, it's the biggest thing they could have thrown at the market to stop it. So I think we're more and more at risk now, from a recession standpoint. And typically the market bottoms in the middle of the recession. And we're only going to know based on how the Fed identifies that, based on the formula, we're going to know that after the fact. And they'll typically announce that, we were in a recession a year after coming out of the recession, or after a year after the recession started. So it's not, everything that we're looking at, these are just, they're really just tools. So, and it takes a lot of experience, when you get a choppy market, to navigate through this. And we don't know anyone, the guys that we have great relationships with, we don't know anyone making money right here. It's just treacherous, the up, down, you're trying to buy leading stocks, getting stopped out. The only thing that's holding you back from, getting killed, it's your position sizing right now. But, the oil stocks certainly look shortable here. There's the OIH that made a 52-week high. And, the XLE, the drillers and so forth, that looks like it's potentially rolling over. So, and then these stocks that were particularly, quote, that Wall Street and people on TV say that are cheap, they're not cheap. Financials aren't cheap, and they don't represent quality, if they're going straight down. So the big money's not going to be made in Google or Amazon, AMZN, that don't have any growth. It's going to be years before Amazon makes a 52-week high, but people are buying these big cap names right now because they need someplace to put the money, and they've got pristine balance sheets. But, we think that you don't want to be necessarily in the Qs and the Apples and Googles and Amazons and Netflixes and all that moving forward. It's going to be a lot of these dynamic companies that we mentioned earlier, but just the environment might not be right. But for you to get triple digit returns, it's not going to be an Apple. Apple's not going to double, in the next 12 months. But many of these companies that we went over earlier have the potential to double or triple, in the next 12 months if the market environment cooperates.
Hey, Roy.
Yes.
would you mind looking at Transmedics? It really held its gap up after earnings and then cratered the last couple of days, but only down to the bottom of that candle.
So this is the stock that we have on our watch list. It's on our focus list. You can see down here at the bottom, Charles. And for those that aren't aware, this is a company that has, they've got a device. It's like a storage bin that's you can move around, where you transport organ transplants with using warm blood instead of ice. And apparently it's more efficacious. It's producing better results. It's keeping the organ alive longer. And they're the only company that's been FDA approved for the device. It's a small company. It's a tiny company with only a $2 billion market cap that shows tremendous potential. It's a tremendous market moving forward. It's just small. So it's trading only about $35 million a day. But the action, look at this. I mean, this is perfect action. This is what you want to see. But the institutions aren't in here yet because it's so small. And so you have industry fund and owners. You've got 350 companies in it, mutual funds that are in it. They're not profitable yet. There are only 32 million shares outstanding. This is how great companies start, like an Intuitive Surgical and Surgical Care Affiliates and all these, medical device companies in the past. Look at the revenue growth, 15.9 to 20 to 25.7 to 31. But if they disappoint, Charles, that's the risk. And we never know. They could lose. They could lose a couple of their customers that are in the pipeline, and end up moving their quarters back, loading their quarters, and the market doesn't like it. You don't have a lot of institutional coverage on the stock, but it's got perfect action. That's exactly what you want to see. And now you need to see what happens here. But it's, broke the 21-day, it's come up. And I've owned this stock. I've owned this stock recently, but I think I sold it about a week ago and looking for an entry point to get back in. But this could be a big stock. It could be a big stock, and it's a perfect candidate to be for someone like, Merck or Lilly or somebody like that to buy them as well. Great revenue growth, no earnings yet, but what I read about it, it's quite it's quite positive. Charles, do you have any comments that you'd like to make about it regarding it?
No, I don't know as much on the fundamental side. It was really, I knew that you were in it, and then when I saw what happened when it gapped up with earnings, and then held it when everything else seemed to have been losing their gap ups, that's what got me into it.
And I bought it. We haven't bought it for the fund, for our clients yet, but we want to. But we can't have 30 stocks that with market caps of 2 billion either. It's you've got to have a fine balance there. But this is exactly, see how I have the trend lines drawn there, those pivots. That's just perfect. That's perfect action. And now if it goes sideways, you can buy the pullback here and try to see see if it comes back to the 50-day, and if it goes sideways, it comes back up and down here and then breaks out, you can add to the position. That's how I would handle it. I like the setup a lot, coming in, buying the pullback, and then pressing it on the breakout.
Perfect. Thank you.
You're welcome.
Hey, Roy, can you check out, it's another small cap, XPOF. It's the fundamentals are great on it. It's an IPO.
Is it, this is Exponential Fitness, Brad?
Yes, it is. And it's got fund accumulation, pretty strong fund accumulation as well.
Man, it looks fantastic. I mean, so it's a stock trading, what, $14 million. And Wes and I were talking about it because, you know, if you get something like this, that's like an orange fitness, Wes.
Yeah, I was saying, I don't fully know what it is. Is it, if it's only virtual, but I was comparing it to an Orange Theory.
Actually, I think what they do is they buy up other boutique gyms that are successable. And they they're creating their own conglomerate of boutique gyms, if you will.
Yeah, it's like Pure Bar, and they do like Soul Cycle stuff and
Very
all
unique.
the trendy stuff.
Yeah.
Yeah, nice.
I wonder if they have any in Charlotte.
I'm not sure.
Need to Google that. Look, this is really great action. Look at the earnings report. See, that is exactly what I'm looking for. Like 90% of the time, a great response where the volume expands. And if the stock can go to new high territory on the earnings report, that's how you get stocks that double. See, that's in a good market. This is going to go from 30 to 60. And, 30 to 60 in the next earnings report. And, last earnings report, it was at 20, it went from 20 to 30. And you can see it go from, 30 to 45 and gap up and go from 45 to 60 on the next earnings report with higher guidance and improved results. And I think this is where the leadership is going to come from. Companies like this, Brad, it's also in this real niche area in terms of the earnings per share ranking. I run a screen over here with earnings per share rank between 70 and 79 and relative strength over 85. And this is one of the screens that I regularly run to catch like just a few group of stocks that fit this category that they don't have the criteria where they'll make it on the IBD 50 list, or necessarily they might not make it in Market Smith and the Market Smith 250. And you're going to catch some of these. And this is on this list with the relative earnings per share rank of 78. And I noticed this like over 20 years ago when a couple of money managers that I had money with back in the 90s, and I was looking at the criteria of the stocks that they had. And they had a number of these stocks that tripled that had this criteria when I went back and back tested between 70 and 79. So you can see on this list, for example, what's on this list. And look how small the list is. See, the list is only 16 names. There's Booking Holdings, which is Priceline. There's ASML, a great semiconductor stock. There's that South Silicon Lab that we own. There's that PI Impinj that we own. There's Onion. There's the sneaker company, ON Holdings, that that's very popular. And so this is sort of this fits that character, that criteria right there. So, you've got great revenue growth. I mean, great revenue growth and if they're doing a roll up, that's, some of the greatest companies out there have been roll ups, where you just constantly, you constantly buy companies like this and just roll it up and you get bigger and bigger. And then you end up, selling out to one of the big players.
Can you open up the edit on the Market Smith just to see, so I can see what I see? I'll take a quick picture. Just want to get that screen.
So I've got it in the top, what I like to focus on are the top 40 groups in Market Smith. And here you've got to have sales growth of over 20% with a relative strength of 85. That means that it's rebounded from the sell-off and an up-down volume over 1, price over 20. and so forth, and nice criteria.
Great, thanks.
Hey, Roy, could you have a look at Marathon Petroleum? It strikes me, it looks different than everything else in the oil sector, MPC.
So, this is, it's quite, the numbers are powerful. The numbers are powerful. Look at the numbers here, above 49, $10, $7, $6, tremendous, tremendous numbers. And the stock is actually holding in here. Why you want to be careful with something like this, in my estimation, is that earnings are going to get cut in half next year. So a lot of these stocks, they're not necessarily cheap just because the PE is like 3 or 5 or 7. These, along with the tankers, have very, very low PEs, and we'll pull a few of those. We'll pull a couple of those up just to show you. So the numbers currently are great, but if they're going to, if they're going to cut their earnings by half, the stocks, it's going to be very difficult for institutions to buy it when it's, when earnings are going to be down 22% this year and 35% next year. So you have to be real careful with something like that. And just to give you an idea, like Zim, which was a shipping company that was leading, the leading shipping company, Israel-based shipping company that had a great run. You can see that where the stock moved from a 10-bagger, went up 10-fold. See right there in 2020 to the top in 2022. Peaked at 60, dropped from 60 to 16, so dropped 70%. And the reason is you had peak numbers. See, look at the numbers over here. In 2021, $39, $38 to $2. And that's why
Are those numbers from the company guidance, or who's providing those future numbers?
I think, I forget who Market Smith gets it from, maybe Fundstrat, or it's a reputable service. It's a consensus number. It could be someone like Zacks, Fundstrat, wherever they get. I mean, the numbers are going to be accurate. If the numbers are going to be accurate from a consensus standpoint. So there's Zim. So it peaked. See, it peaked back there when you had peak numbers. $14. See, way back here, the March quarter, going back a year ago. Look, see the March quarter, guys, right there. So even though the stock had these great numbers, those were peak numbers, and the stock had already moved up 10-fold. So then you get into this long, laborious downturn, and which wears you out. And so everyone's buying the stock because it's got a 1 PE. They're buying the stock, and you're underwater. It's in a stage 4 downtrend. Stage 2, stage 3 rollover, then stage 4 downtrend. Now it's back in a stage 1, building the base. So that's what you have to be careful of with that marathon.
Hey, Roy, Zim is supposed to be paying a $6 dividend in a couple of days, I think today or tomorrow or something.
So and that's, they were paying a terrific dividend as well, like during this whole growth phase. Think about that 6% dividend. That's going to be, that's a humdinger. It's
$6.
Yeah, $6. Yeah.
Yeah,
$6.
on like $23, $21, $22. So that's why it's been shooting up.
Yeah. STNG. See, this is another shipping company. See, I think it's got peak earnings in here. You have to be careful with these, particularly if you haven't been in them. Now you see them because they're hitting, they hit the new high list a long time ago, and you've had this major move. So you just have to be careful with these stocks that, that have great numbers, but they've got peak numbers. The peak numbers are behind them. So you see, look, 429 in September, the September quarter that was reported in October. So you have to be careful that in this earnings period, that's not peak numbers, and it subsequently rolls over. Let me pull up the Market Smith Growth 250. That's their this is Market Smith's proprietary list that typically have no more than 300 stocks. It's called the Market Growth 250, and it's a proprietary list based on relative strength, based on many different screens that I forget who designed it. Mike Webster. Mike Webster, I think, designed this back in the day, and based on Bill O'Neill's request. And it primarily starts out with industry group rank, and it identifies the leading growth stocks that are based on these 28 screens. So you're going to get, in a bull market, this is your fishing hole. This is where you should be focusing your efforts. You're going to get a lot of those stocks that turn out to in the future that turn out to where they doubled or tripled. They're going to be on this list. So there's United Rental, which has been a leading stock, and look at this run on this United Rental. So 300 to 500. Now it's rolled over, as the market has rolled over, but that was a big winner recently. And there's Wynn Resorts. See, this gaming area is real hot, and Wynn in Las Vegas, or the way to play it, it's the number 6 industry group. There's that Steel Dynamics Nucor that we were talking about earlier in the steel area, the second rated group. Semiconductors remain at the top 5 group. And, there's Lattice Semiconductor that made a new high today in price. Rambus, Broadcom. There's Mobileye, the chip company that was not spun off. Intel owns this company, and they're primarily in the EV market. And they've got, so this is the second largest IPO that's been brought public in the last 2 years. And the other one is a solar company, I think NXT. But Mobileye, you can see an IPO that's been quite volatile here at the top. And we haven't, maybe we tried it and got stopped out on a small position after earnings. But you can see, I have a trend line drawn here to see that's where your first resistance is. So we'll see what happens here. Some of these companies that they come out and they break into new highs, they really, really move. But notice this, see, this stock came out at 21, and it went from 21, it did go from 21 to 40 on the move. And that NXT, this is a company, this is a solar company that's going to reporting earnings, I think Array, ARRY, a competitor, is going to be reporting earnings, I think, tomorrow. But this is an IPO that's been real volatile. But we have our eyes on this stock. Closed in the middle of the band today. But if it does the same thing that Mobileye did, well, Mobileye doubled from the IPO price. This suggests that this stock in this environment might go to 48 in the current environment. And they've got great numbers, doing $2 billion in sales. And they have easy comparisons too. See, the last quarter was 467 million. That's going to be compared to 337 million. Those are huge numbers. And it's also new merchandise. So if you see a stock like this that goes to a new high now, if it takes that high out, then the market, there's a good chance the market's going to be in a new uptrend, and a stock like this might be leading the way. So this is something just to keep on your watch list. But you have ARRY that's reporting, and tomorrow, reporting tomorrow, seeing one day, and they're in the same business. So you want to be judicious in terms of seeing how Array does. And by the way, First Solar is the leading solar stock in the group. That's the one you want to own. And the problem with this First Solar, it's in a bad group, rated only 134. So it's the best, it's the best, house in a bad neighborhood, I guess. But that's the lead, and this stock never gave you an opportunity. There's your 10-300. I think Joseph picked this out, I think, if I'm not mistaken, on his Twitter feed. So it's up 10% in price, volume up 300%. And this is, if this stock it hasn't even gone to the 21 days. So keep your eyes on this to see if this is going to be a big winner.
I think Max N is another one in the group that had went up on 10-300.
So look, that's great action. See, in a really good bull market, guys, you can have this happen just like this, a semblance of this, and they're going to all work. And that's why, we're so diligent, and we think that now's the time to just double up your efforts to see, well, if this market can shake you out here and make the next move up, and you're sitting there on the sideline, or we can take another leg, lower, where you have to be open-minded, knowing that you're going to lose money if the market pulls back. I mean, period, end of story. You're going to lose money. You just have to control it, because you might have 5 or 10% downside and 100% upside from definitively when this market downtrend is over. So that's the skill that's going to take you to decide to when do you really allocate money, and where do you allocate money to. I'm just showing you what I think are the best ideas, and it's not going to be the stocks that are making 52-week lows, or even those that have bounced off the bottom, except in selected cases. It's going to be this kind of stock. How can a stock break out and make 52-week highs in this market? Well, something's going on, and it had to do with earnings. So that's exactly what you want to see. Thank you, Joseph.
Roy, can you have a peek at TENB? It's in the cybersecurity, which
Team
TENB.
TENB.
Yeah.
Middle East, Africa, Asian.
The weekly chart looks.
The weekly
looks better. Showing.
It's interesting. So it is consolidating. It is consolidating. It's in a really unique area. So it's in Africa. Middle East, Africa, Asia Pacific. And I don't know if there's any. I don't know if you have companies like Fortinet and Zscaler and Palo Alto Network that are in those areas. I'm assuming that they are international as well, but it does look nice on this consolidation. You got 2 good quarters that have gotten they've experienced. Nobody's following it, and you do have institutional ownership, and you're also in a short-term uptrend, so you're in this cheat area. And relative strength is 79. I'm really looking for relative strength, at 90 or above. But this is how these nascent uptrends take place. So it's interesting. The relative strength line looks like it's outperforming the market, the relative strength line, and it is consolidating nicely there, and nobody knows about it. So if I'm right on top of the fundamentals, see, if you bought it on the pullback to the 50 and the 200 right there.
That's where I got in there. Yeah.
See, right there, you can press it. If you bought it perfectly, so you bought it perfectly on the pullback, you buy a little bit more right there, and you buy, you fill out your position right there. going up, and, you buy less every time it goes higher, but, you try to get your position on. So that's how I would handle it from a trading perspective.
Okay, thank you.
Market Smith growth. Let me see who else is on the growth 250. And see, notice here, you have plenty of ideas that are in the top 40 group. And actually, if, Bill O'Neill wrote a book, and he wrote a book also, 24 Essential Rules for Success, something like that. And what's neat about that book is he's actually, he gives some more color in how he built his reputation. Now, this guy was in Market Wizards. Bill O'Neill is famous in he's in, he's thought as one of the greatest traders of all time. And a lot of people, aren't even aware of who he is, except, this IBD community. But man, he had a terrific reputation. And he was, I think, the youngest guy to ever buy a seat on the New York Stock Exchange. And he actually, my point being is I read where he actually said that he prefers the top 4 groups. So imagine keeping your buying to just the top 4 groups and trying to get, the top stock in that group. There's NVIDIA, of course, in the semiconductor area. A couple of oil and gas stocks. The transportation stocks that we're setting up. ODFL would be one of and SAIA would be one of our favorites. And that's the earnings report. See, it's all about the earnings report, and it's all about the action. So a stock that, goes up, gaps up on the earnings report, in a good market, it handles and consolidates. You don't come back and fill in the gap. And that's the market, not the stock. So many times, these pullbacks, if you're crafty enough, you can buy a little bit to try to initiate your position. And, and you're closer to, if you buy it here at the 50-day with a 10% stop, you're, the odds are that, it will work. See if there are any, the home builders actually, guys, are setting up. So now, how in the world, with the rise in interest rates, and we know sort of what's going on with the mortgage market, but the home builders are the 10th rated group. And we were looking at this. Here's Lennar. So Lennar, great institutional covered by firms, 1,800 firms cover it. And the stock is close to breaking out to a 52-week high. There's the 52-week high. So why are these home building stocks, 93 relative strength, going up? And because presumably it's in the stock, and next year rates are going to come down, and these guys, we know inventory levels are really tight, and maybe this is where the leadership, comes from. It's in the 10th group now. So it winked at you. See, look, there's the earnings report. There's the great action. Now it's coming into the 50-day. And so, you can take your pick, DHI, MHO, MTH, Green Brick Partners. But you want to be in the ones that have liquidity. DHI has a lot of course, liquidity as well. And trading, $250 million a day. And the numbers right now aren't great, but again, look at the relative strength line, and you've got the blue dots, so the relative strength line is making a new high. And so it's out, even though the market's been down, the relative strength line, it's beating the market. So you've got that dynamic going on. And the earnings estimates aren't that great. So the earnings estimates aren't that great. But this is sort of telling you maybe Wall Street's behind the curve, and they're way behind the curve. Because I know here in Charlotte, we don't have much inventory at all in terms of new homes. Doesn't mean that, and the market environment it hasn't been conducive for someone to sell their home and turn around and buy another one at with the mortgage rates where they are. But we just showed you where the Fed funds futures are showing that rates potentially can go lower here. So of course, that's only going to be a wind at their back in the home builders. So I think that's important to take a look at that.
Roy,
Yes.
how do you square this and some of the setups with, that kind of binary event that we have coming up in a week? I mean, do you just, if you see them set up, you take the trade, or is it, it could go either way next week with the Fed.
Well, I think, Dana, I think it's in. I think it's in. I think if the Feds can go 25 basis points, because remember, as hawkish as Powell was just a week before, and then he broke something. So I think, he's going to raise, if he doesn't do anything, he'll save face by raising rates 25 basis points. If he doesn't do anything, then he's going to admit right there that he's wrong, and he's not going to know how wrong he's been. So I think he's going to raise 25 basis points, and then maybe 25 basis points depending on what new information comes before the May meeting. But I don't remember, there was a 78% chance a week ago that it was going to go 50 basis points.
Yeah.
So what a turnaround! But stuff is, I forget who I forget who was the philosopher, the economist that said when the information changes, I change. When the data changes, I change. The data changed. The data changed in one day, and in a meaningful way.
Setups, if they're there.
You just have to be. I think you go in incrementally too. Like you don't go from 0 to 100% or 20% to 80%. In a couple of days, even if the setup's there. But I think you have to be careful that we run into resistance right here and we fail, and then there might be an exogenous event. Typically when you have an earthquake, you have an aftershock, right? So I think there's going to be more aftershocks in terms of with the banks. But if you let the market, if you let the stocks tell you, but the indexes, they pretty much have to cooperate as well. That's what I would do. But all the stock, Wes and I were talking about, all the stocks we would have bought yesterday, but we were afraid of the market and the follow through. Even though the market is extremely oversold, markets crash when you have conditions like that. Like in the 2018 bottom, when you go back and you look at the bottom, it was the last 10 days killed you. In the 2020 pandemic bottom, it was the last 10 days that killed you. In the last, the market was looking like that. The market would have done that without the Fed acting, without the Fed, the FDIC acting. We would have been, that's what happened this week. We averted, and it's funny, 90% of the people out there aren't going to be aware of what we averted. I mean, we averted, a crash. So, it's Dana, it's just tough to, it's tough to say. This is just kind of I'm trying to give you, and the group's given us a great menu of ideas, but it doesn't mean that you take every idea, and it doesn't mean that you go to 10% positions, either immediately. I mean, I'd like to see them work. I mean, really work. And, all these companies that have great fundamentals, the stock should be going higher.
There's another one in the med tech space, along with Transmedic, PEN.
Oh, yeah.
Penumbra.
So this is the kind of chart. This is what you're looking for. What's their product? So it's a vascular. I just touched base on it. So they're doing $1 billion. You know, apparently what they're doing is they're having sales, you know, follow through. You don't have great growth there. Look, 203. I don't know why growth is so flat. You know, revenue growth.
Yeah.
And they've got really good numbers. And so, you know, you can have great earnings growth with great cost containment and great margins with not great revenue growth, but the revenue growth is uninspiring. You got a lot of people in it though. Look at the mutual fund growth index. You got 3 top funds in the IBD mutual fund index there. You got 500 companies. More importantly, you've got great action, right? Look at that relative strength line, of course. So this is one definitely I would, definitely to have on your watch list potential, your buy list when it recovers. I wonder what happened here. Look at that biggest volume day, right? See how it went up and down? I think there was some shenanigans going on in the market too that day. But if it recaptures that base, that would be a strong signal. So this is where leaders can come from, like the stocks, that doubled 38 million shares outstanding. See, they could split this, 2 or 3 times to get the price back down. Although there hasn't been an inclination for a lot of companies wanting to do that. But certainly great action, here. It's definitely something to pay attention to, Dana. Alan, did you have a question? I see the box is lit up.
No, sir, but thank you.
Okay. There's Planet Fitness, the XPOF.
Right. I think I missed when Wes was talking. TLT, how large of a position are you guys currently sitting with? Are you adding to it on the steady, or
we're stock guys. However, we think there's opportunity here, and we have a 5% position that we put in. What's today? Tuesday, Friday, in the TLT, and we want to get. I mean, we think that there's 25% upside in the next 12 months in it, but based on what we talked about before, and we've got a 10% position in the IEF. That's the 5 to 7 year. We put that on right there. So of course, this isn't an investment recommendation. We're just telling you what we're doing, and we certainly can be wrong, but we think we want to get heavier here in both of this. In the 2008 bear market, we got clobbered, but bonds really did provide ballast. And we've had a negative outlook for bonds for us until Friday. So that's something we're changing as we get, we're changing our view as things change. If the market, because we think it's a win-win, we don't think there's going to be a soft landing. We think there's a better chance there's going to be a hard landing and a recession, and rates will go down in a recession. So in a bad market, rates are going to go down. And sort of the setup of where bonds are, we think we've hit the high in the cycle based on what we explained earlier. But it's not going to be the problem if you have a huge bond portfolio is you're not going to make these stocks that we're talking about coming out of the bear market like 2009. I remember every bear market, you can be up 25% in 90 days, in 45 to 90 days. And here, this is like a year type of a setup. So many of the, many in the group are looking for the home run triple digit numbers. And we are as well. We just think that there's, we think there's, that there's a setup here. So we want to, we would, we have clients that that are in fixed income, that we're in short term, that we're moving here. But I think it does, represent, we might be 30% long in bonds. And we're 15% long now. And the PPI is coming out tomorrow. And we do have that event that Dana talked about the Fed. It's the Fed event where the Fed meets the 22nd. So you have two other big pieces of information. It's not what they do or say, but it's what the bond market does that's going to be important.
Imagine if he comes out hawkish,
if it comes out high,
if he comes out hawkish, then
yeah,
I'd imagine the yields will climb or make it.
The PPI. See, 25. It's in. Remember that yield curve, the Fed funds futures. That's based on expectations. It's based on expectations. So the expectations aren't going to change with a 25 basis point move up, and they're not going to change if the Fed does, if they sit on their hands. And but if they don't do anything, they're going to acknowledge that they broke something, and that's going to be that's going to be embarrassing because it caught them off guard. That's going to be embarrassing. Caught all the bank examiners off guard. They should have been aware of this. The potential. That's what they're paid for, to assess the risk, in the financial markets, specifically in the financial area.
My guess is that he comes out and says, "We've never raised rates as fast," so this was one of the unknowns that just kind of happened, right? I don't know what else to say.
Yeah, I think.
Is that really true? Because the same thing also happened in 1970s and 1930s. Everybody's talking about last 10 years, 20 years, 30 years. We need to go back and look at same time period. If you look in 1970s, didn't we have the same scenario where the rates were going high, just like they are doing right now? They had a pause. They actually reduced the rate in 1970. Market thought everything was great. And then Walker came and said, you know what, not going to happen. And then they raised interest rates close to 10 or 11%.
Yeah. And was that Yogesh?
Yeah.
Yogesh. Yeah. And I agree. And Powell has often commented regarding that, and he's on record saying that he doesn't want to stop. His mandate has been, we're going to get there. We're going to finish the job. It's going to be higher for longer until an event occurs. And remember, in the 2020 panic, remember when the credit markets froze up, they did the type of action that just occurred in the financial markets. They pivoted. They did that also in 2018 when the market bottomed December 24th of 2018, that bear market. They pivoted a couple of days later.
But we are not in the same environment anymore, right?
We're not.
Back in 2018 or 2020, the rates were very low, and they didn't have to worry about it. Right now, we are in an environment where inflation is 6%. If they don't increase the rates, we run the risk of getting higher inflation, which will again damage the economy going forward, and they will have to raise rates even higher.
I agree with your premise until what happened Friday. That changed the game.
It's deflationary, that kind of action in the financial system, I think. And my other feedback on the
You are
on the
exactly
different
right.
environment is the
You-
starting point. Because in the 1970s, you're going from like what 5-6% to 12% or something. So you're doubling your interest rate. And we just went from 0 to 4,
Yes,
which is
so right, so we need
percent
to
basis is
understand why
massive.
this is happening, right? Before in 1970s and 1930s, we were not having 0% interest rate for a very long periods of time. Right
But remember,
now,
we didn't even have the
Yeah.
Fed, the FDIC. Remember in the 30s either. That's that we didn't have, and the economy was much different now than in the, and then in the 70s. The economy is much more robust and larger. It's a different, we have a different economy now than we had in the 70s. I think, I think we're not comparing apples to apples necessarily.
True, of course, we cannot compare because the economy is different, the businesses are different, the industries are different. But I feel that my personal opinion is that the Fed will increase quarter basis point for this time. Next time they might pause. By end of summer, we will realize that inflation is not coming under control, energy prices are rising, and they will be forced to increase rates again. And basically by the end of this year, we might end up actually going into a recession, which hasn't happened yet.
And that's a great point. And in fact, our data shows that, that inflation is going to come in like the next couple of months. And then you have the potential in July to reaccelerate if the economy doesn't weaken substantially. And, Hedgeye, Keith McCullough believes that we're going to have 2 consecutive quarters of negative GDP. And so that's what's different. And that's modeled quite different from what the Fed believes, because I think the estimate for the Fed report is GDP is going to be 2.2 this quarter. And Keith McCullough actually has GDP going down. That would be, that'd be a huge difference, huge difference.
Right. So I would be actually looking at the credit spread, the chart that was shown earlier, and in conjunction to that chart, I would be also looking at the unemployment rate, because that would solidify my belief that if unemployment rate starts going higher and credit spread also starts going higher, then I can guarantee you that 90 to 95% we will land in a recession come next 6 to 8 months.
Yeah, we agree with that premise, and it can happen. There's the old saying, risk happens slowly and then all at once. And I think that's if that environment happens and those OAS spreads really increase, that's going to tell you that there's problems in the system and something, there's going to be another episode. There's going to be, again, it might be the aftershock effect. So we just have to, you have to just try to navigate and observe the data and, look at the fundamental factors, look at what might happen, look at what the charts are telling you to try to make an informed, decision that may be right or may be wrong. But I don't think you don't quote bet heavily either way here until there's more clarity.
Yep.
Certainly a balanced, modest approach is the best thing to do. You don't have to be, if we begin a sustainable bull market, it's going to last 3 to 4 years. And the markets can be up 100%, and and your portfolio is going to be up 200%. And in 2 to 3 years, and you don't have to get the first 10% to make 100%. These stocks have to start working, and the ones that we're mentioning to you, the ones that are going to do that, they're going to be growth stocks. They're not going to be value stocks or cyclicals. They're going to be in growth. And the key is to try to identify these innovative, great, vibrant, innovative companies, that have something new that people want and need. And the bigger the market, and the bigger the market, the better. That Bill called those stocks big stocks, those that had everything, the firepower behind it. The companies that turned into, I mean, you know, when you look at Google had everything, you know, the whole world was a potential client. That's what we're looking for. And we don't, you know, we're going to have some IPOs that show up in subsequent years that are going to have great number. Maybe it's in artificial intelligence, maybe it's in robotics. They're going to show, maybe they'll be in biotech, like, you know, the SRPT they had a positive drug announcement and stock moved higher. They made an announcement that the FDA is not going to have them go through another trial. So that means they got approval on a drug that's going to show up. And you can see this is a stock with no earnings that are going to make $5 next year. So it's going to be companies like this, and they're going to perform, you know, they're going to perform in a recession or a non-recessionary environment if the product is so good and the world needs it. This is the kind of action that you certainly want. And, you know, the blast off, the pullback to the 10 and 21 day. And, you know, this is certainly on our watch list. A lot of institutional sponsorship and relative strength of 98.
Roy, in your scenario for a hard landing, do you envision a time where no equities will work, where we'll have to go to some other instruments?
I think in a hard landing, yeah, and you know, they're good. What's going to happen, and you know, if we have a hard landing, the market is going to bottom, and it is going to discount that in the middle. In fact, we've never had a bear market end without being in a recession. Never, you know, over the last, you know, we've talked about that data before. So, you know, if we go in a recession, that suggests, you know, that we're going to have a slowdown in earnings, and price to earnings multiples are going to really go down. I think we're trading at we're trading maybe an 18 to 19 forward multiple. And in recessions, we average like a 13 to 15 price to earnings multiple. So what that does, it suggests that on a valuation basis, we go to 2,800 to 3,000 on the S&P.
So does that mean for you personally and as a trader myself, is that we start to look at shorting as the mainstay?
We do. The market goes up 3/4, you know, 2/3 of the time, 3/4 of the time, you know, historically. We just don't do a lot of shorting. You know, we think we'd be in cash, you know, have a great amount of cash, or, you know, we've thrown out the opportunity, you know, in a recession, a hard landing, but rates are going to drop 1.5%. And you're going to, you know, you can make 20% on your bond portfolio. Remember, all these short-term, you know, the T-bills and the, you know, 90-day bills, they're going to go down significantly, which is fine. I mean, we've got a lot of money there, but for you to make gains, it's going to come. It's going to come in your bond portfolio.
Great, thank you.
You're welcome.
I think it's hard to take a stand in shorting. Like, I think we've priced in a lot of bad news the past year so far. I mean, we might just be halfway there, who knows? But it seems like we've been in a bear market for over a year now. So, I mean, I would imagine a lot of bad news has been priced in.
Yeah.
It's like 2 years for growth, 2 years bear market for growth.
How about, take a look at this, just to put everything in context. And I mean, this is where we operate. You know, if you're in the IBD universe, if you're a growth investor, if you've been in, if you've been in a lot of these, you know, growth stocks, let me pull up something. Let me show you this and show you the environment that we're working with. I want to pull up the IBD 50 index, and I just made it It's 0 IBD 5, I think. 0 IBD 5. So there's the IBD 50 index, and this is going, this is the last 6 years. There's the 2018 bear market, and this is pretty brutal. And there's the 2018 bear market. We bottomed December 24th. Then you had the nice move, and you went up a year, consolidated, went higher, and then there's the 2020 pandemic. There's a 2020 pandemic, and notice here that this was you had a 35% drop in both of these, but it was over before you could do anything. It was over within a month. But there's the weekly. Take a look at it in the monthly. So there's the 2015 bear market. There's the 18. And the 2020, look, within 2 months, you were at all-time highs. So this has been unusual from the standpoint of how the duration plus the magnitude. We've been down. This is down 50%. Look, 600 to 300. That's an index. So with this index being down 50%, there are tons of stocks that are down 70, 80, 90%. So we've just gone through something that has been rare besides 2020. That's equivalent to the 2008, not really, but the 2007 to 2008 bear market that lasted 3 years. I mean, we've only been going down a year and a half, but it's showing you bottoming action, and we potentially have discounted. We have discounted a lot of the damage because we have so many stocks that, that went down so much. But that's the environment. And see, when this environment changes, and that's the monthly, when the environment changes, you're going to see a lot of the stocks that we just talked about. And notice it's still trying, when you're looking at it, it's still potentially looking like bottoming action. So that could, right here, this could have been just a shakeout right here to shake you out. And then we take off. But it took out, the reason that everybody got bullish, including us, is we took that level out. But it immediately reversed. So it took it out. And so it started to make a higher high. So a higher high. Now you've got a higher low through, looking at it that way. So, the next time that it takes that out, it's potentially game on. And we can't predict. We can just only, we can only act. But now, if you take that high out, you take that out, and there's a good chance that, that we have bottomed, and it looked like we had bottomed again, this month, and then the reversal, in the last week or so. You won't hire. See, look at the 2018 bottom. You moved up, and that's how you know that the low was in. Where you kind of consolidated for a couple of months and then took it out. So we could just consolidate here for a couple of months and then go. You just have to be open-minded. It could go either way.
Roy, what's your worst case for the SPX?
Worst case is going to probably be, 25 to 2,800. In a hard landing, if it turns into like let me pull the S&P up. That's the worst case. Like this 2008, and that's a 50-month, by the way. This is the magenta line. That's a 50-month, and see right here, where the 50-month was support, and then it went through it, And that's when the last leg of the economy, the real estate crisis really hit before, you know, you had the next leg down. And it was, look, it was about 3 months. See right there?
Yeah, okay, I think I see where you're going, yeah.
Right here. See, it was, and see the last 90 days right there, boom, boom, boom. And see, this is a 50 month. So if you take that 50 month out right there currently, then this opens the door to going to like halfway, giving back half. There's the pandemic getting right there. And that's, you know, 2,800.
Yeah, got it, thanks.
And that's going to be over the course of, you know, that's going to be over the course of, you know, the next, you know, 6 to 9 months if it happens. But, you know, if we try to, you know, we bounced off the 50 month before, like we did right there. But if we break it, then it could get nasty. And here's the 2000. See, when it finally broke, see where it broke right there? It took you another year before you finally bottomed. So, you know, if this economy comes unglued and, you know, we're going to be in a full-fledged ridiculous recession and things are breaking all over the place and valuation and panic hits, that's the downside. So, you know, you have to be careful that if we take this prior low out, that there's the downside. It's that, you know, it's really, Wes and I were talking about that. It's 2,600 to 2,800. We, you know, for a long time, we thought the market would come back to 3,000. And then the market bottomed off that 50 month there in December.
Sorry, and is the green line the 20 month?
10 month.
10 month, thank you.
So that's a 10 month and the 50 month. And we've long used this as a pattern of support, you know, in uptrends, a pattern of resistance and downtrends. You know, going back for 3 decades.
Roy, I got a quick question for you. This is Tim from Las Vegas.
Hey, Tim.
One thing I was, when you guys were talking earlier, I was very surprised you didn't talk about tips or gold. Is there a reason why you're not thinking about either one?
We don't have a lot to say about tips because they just have, you know, supposedly they're, you know, inflation adjusted bonds and they've gone down while inflation has continued to go up. I don't understand why they've done that. And regarding, and we are interested, you know, there's been this inverse relationship between gold and the dollar and also long term. And our guest that we had a couple of months ago, John Roque, really thought that we were, you know, that we had this big base here, and it is setting up. See, look at this base, and that's a 1, 2, 3 year base. So, you know, if this gold breaks out and goes to new high, you know, this could be a very sustainable big move here. And the way that you know, of course, the way that you target, you know, you take the top of this of the base and take the amount that it drops. So that was 180 to say 150, like 30 points. And so your immediate target would be about 210 points, 210 from here. You know, that would be a short-term target. So you can see I have this trend line drawn, and you know, it's a slower mover, but look at when it finally broke out back here in the, you know, but look at, interestingly enough, gold in the bear market was down. There was no hedge. So gold doesn't necessarily provide. Sometimes it's, you know, it's a hedge. Other times it's not. You lost 20 or 30% of your money having your money in gold as a hedge of the stock market. It doesn't really perform great as a hedge in the stock market. There's a better relationship between gold, inverse relationship between gold and the dollar. But it's, you know, it is interesting. It's supposed to do good. do well in this quad, in the quad that we're in as well. But we don't have a position yet in it. And, you know, there's a stock in a nice uptrend, then it broke. Now it's, you know, it moved up inexplicably, you know, that Thursday and Friday, just the way Bitcoin
gold is, it is not a hedge against stock market. It is actually a hedge against instability. So since we have the banking crisis, and that's where the gold moved so quickly within last 3-4 days. And if we continue to have more banking crisis going forward, which most likely we will, then that has the potential for gold to break out. But at the same time, you will also see, you might see dollar going up, gold going up at the same time, and that inverse relationship will break down.
Yeah. But there it is, Yogesh, in the great financial crisis. There, we never had such financial instability there, and gold went down, didn't go up.
Yep.
So sometimes there's an inverse relationship. Other times there's not. It's difficult to linearly just say there's just an inverse relationship, and if the dollar goes up, gold goes down, and vice versa.
Mm-hmm. Okay.
It's tough to, it's a tough.
No, I just want to hear your point of view on that, because I thought gold was doing so well, and it's just like no one really mentions it.
Yeah, you had that big move right there, and you had equities that moved up, after the bear market, and then, it's been, you've lost money for, the last, 12 years. If you bought gold there, you're not even after 12 years. So,
True.
It's worn out, everyone, so it's going to have to get new investors, which is why it's setting up, Tim, why, potentially it's setting up. I would definitely, I like the chart. I think it's setting up.
No, but like you said, with your people who are income driven, the TLT, and thank you for the TLH. I never knew about that one.
And we're, this is the 10 to 20 year, and we're looking at this as well. So, this is something, guys, that, 180 to 100. We just experienced the worst bear market in bonds in probably history.
Yeah. And look at the volume.
So, now I think you take the other side, this is the other side of the trade, and, it takes you back up to here, and, that's 25% over the, and look, but, this is not going to be fast. It's going to take, it's going to take a year. It went down for a year. It's, it's going to take a year to get back up there.
Yeah. Well, he's true to his word, longer interest rates for longer periods of time.
Yeah.
Wouldn't take that long.
Yeah, it's going to put us in the recession, and then you're going to have to, and rates are going to have to go the other way. The market's getting ahead of that right now. It's showing you that potential rate cuts are coming, and until Fed funds got above the 2-year, you couldn't make the statement that that's why a week ago you had people calling for a 6% 2-year, but then it broke. Now it broke, and you just saw what it looked like on the chart. So the chart's
True.
telling you the top's in.
Very true. Thank you.
You're welcome. Guys, we'll go about 5 or 10 more minutes, and we'll call it a night. Just feel free to interject.
Roy, can you pull up, you might have already done it already, but CDNS?
Yeah, this is a very interesting company as well, software company, design company, CDNS. And look, this is a long-term chart, the weekly. Man, that thing looks great. You know, this is a stock. I mean, if you're lucky enough to get one like this, and you get in it early, and then you can ride through some volatility, you know, it can turn into a big winner, you know, for you. The stock's breaking out is at a new high. So that's at an all-time high today. And that's the earnings report. So we have it, you know, we have it in our focus watch list. Really superb numbers. Pretty big company, 55 billion. And 55 billion, software, hardware, for design, automation company. This is what leaders look like. And the earnings are out of the way. And now it broke out. So in a good environment, like I would definitely watch this to see if this can be a new leader. I'd be, if we didn't have the PPI, if we didn't have the Fed and all that, I would have bought the stock today. Looks great.
Yeah, Roy, can I ask you about bonds? For bonds to go where they were a year ago, but rates a year ago were at 2%. They're probably not going to be there in a few years, if ever.
Yeah. What was your question, Alex?
My question is how you expect bonds to move where they were a year ago in price if rates a year ago were much lower than now, and they're probably not going to go there.
Well, we don't expect them to go. I mean, we don't expect them to go. We think we think it's going to take a couple of years to go, and then we think it's going to be a couple of years, maybe 2 to 3 years before this is it all works its way through the system. And you remember the recession. We got a recession that's going to last for a while. So, this could drag on for a while. We just believe rates are going to drop based on what Fed funds are showing, like 1.5% by year end. And that's what we're looking for. But that can still be substantially higher, than, not on the 2-year, but we're looking at the 10-year and 10-year, 20-year and so forth. We think those rates are going to drop 1.5%. To be back normalized.
Yeah.
And that's gonna provide you the appreciation plus the coupon yield that would be attractive. And we're just gonna play it by ear. If the market takes another leg down and you can make 20% in bonds versus losing 20% from here, and that's the downside, then that's what you want to do, and just bide your time until this environment. What if this lasts another year? And we can't predict, how long this bear market will last, but things will improve. But the market is a discounting mechanism as well. I'm just talking out of both sides of my mouth here because I don't know and no one does know. You just have to act rationally with progressively, I guess, with progressive exposure.
Yeah, thank you. Also, I wanted to ask, how much risk do you think is in money market accounts at Schwab or in short-term government ETFs hold in Schwab?
I don't know what Schwab's money market fund is paying, but banks and money market funds, generally speaking, they've been it's like credit cards. It's usurious. They're charging you 25% for a credit card, right? When rates are down 0, they're still charging you 25%. Money market funds for many of these brokerage firms, you know, from Schwab, Fidelity, Wells Fargo, all of the companies, the money market fund hasn't paid very much. That's why we've been in that T-Flow, which is an ETF with a 7-day duration, just made of treasury bills. That's paying like it was paying 4.6%. And we have millions and millions of dollars there, parked there. But you can do that, or you can be in, you know, individual T-bills.
So my concern is you have your treasury bills for 7 days. Then if accounts are locked for more than 7 days, they need to roll it to another T-bills. And
and it's gonna be so. We've had peak rates there, so it was paying 5% at the top, I think. So now it's gonna be paying, you know, significantly less. And like, I'll show you what that looks like. Let me bring this over.
I'm asking more about counterparty risk, about keeping
counterparties.
Yeah, because it's not security after 7 days, right?
It's not a security after 7 days.
Right. If duration is 7 days, then if something happens,
they roll it, and I mean, they just roll it. I mean, it's like, you know, those are $1 billion. You know, I know the SHV is $23 billion that they're rolling. You know, they're just rolling. You know, 30. I think that's got a 30-day duration, I think. And they're constantly just rolling it. But you know, as long as they mature, you know, you're not going to lose any principal. But you know, you're not going, again, they pay monthly, and so the monthly incomes can come down as rates come down, which is fine. It's better. It's, you know, the same things can happen with the money market fund. This is a better way of parking your money short term.
And also I want to ask, so Mike Wilson from Morgan Stanley, Dana, maybe you want to comment as well on that. He's still negative, and he was quite accurate for the last 2 years.
He's been he's one of my favorite strategists, because he makes so much sense. But you know, he's been off and on. You know, he tried to call was bullish on the market, 10 days ago, and then he got negative on the market. He was out there yesterday with comments where now he's bearish. He believes that the market, as I've talked about, he believes that there's going to be an earnings recession, and that we're going to go to 3,000 to 3,500 because of the revaluation, and he thinks that the higher risk of the recessionary case, and he makes a lot of sense. But he's been bearish. No one's perfect, but he's made some good calls, bad calls. But what's difficult is, as an investor, is sometimes you typically listen to the guy that's most eloquent and that may not be giving you the best advice, but you just, as an investor trader, you just have to take what everyone says and make your own decision, the upside, the downside, and then try to make an informed decision. But Wilson's one of my favorite, and you can Google him and go to YouTube to see his latest comments as well. But he's extremely bearish.
Yeah, he's still bearish. I don't know how was he. I don't know if he's always bearish, but
and he believes that we're taking out the October lows. So there's that's 3,500. So if you take out and that's what happens in these whooshes in the bear market. See, it's the last level from 3,500 to 3,000 that you have to be careful of. And now, I mean, there's a line in the sand here at 3,800. On the NASDAQ, on the S&P. I mean, you certainly don't want to go from 3,800 to 2,800. And so we're in this short-term downtrend now. We're bouncing back up to resistance. It's going to take a little while to get in, quote, to a new uptrend. you know, if you do, let me show you this chart here. If you do take out, see, if you know, you close above that and people are going to be piling in, and we'll be adding exposure too. See that pivot point right there? That's where now, you know, that's where you get more, you know, you get more aggressive. But there's the break. You broke this downtrend, and right there to tell you to get in, and then it immediately failed. But you take that out, and that's looks like that's at 4,100. So you take that out, and then there are going to be more stocks that set up. There should be more stocks that set up, more stocks making new highs, and that's how I would know that a new uptrend is intact. And for those, you know, for a quote, the IBD guys out here that are on the call, this is day, let me see what day this is of the rally. So this is day 2 of an attempted rally, and the window typically opens at day 4 to day 7. So tomorrow would be day 3. So even if we have a big day tomorrow and the market's up 1.7%, that won't be a follow through day. So you have to be careful, you know, because if you know, if the follow through day occurs in the incorrect window, those are liable to fail. And Eric Kroll of the Life Cycle Trade and IBD, if you email those guys, they've got a lot of information about the follow through days. How many times they typically work about 30% of the time, and from their historical records. No new market uptrend has started without a follow-through day, but not all follow-through days work. But it's a tool and an imprecise mechanism to show that the low is in. But you know, we had I think we had 7 or 8 follow-through days that didn't work during this bear market, all the way down that were fake outs. And then we had, from the January bottom, we had a number of follow-through days there from that January bottom to the February top. Plus, we had that momentum buy signal that was so powerful that set up on January 11th to suggest that, again, that the low was in.
Thank you.
You're welcome. Guys, I think I'm going to call it a night. I want to thank you so much for attending. Hope you're on our email list. I hope that some of this information was relevant to you. And I hope that you learned something tonight. I always learn something when I talk to you guys and as we share our comments. And I guess that's pretty much it. You guys have a great night. Hope to see you next month. And good trading. Play it day by day, cautiously until you get some traction, and then be ready to add and put the pedal to the metal if the environment tells you to do that. And it's going to tell you to do that. And certainly, if you're on our call, we'll certainly let you know what we're thinking, and from a month to month basis. But it can turn quickly. And you can go from 25% long to 100% long in 30 days if the market environment dictates. You can also follow Wes and myself on Twitter, and we publish a lot of our thoughts, and we're extremely transparent there, where we talk about many times our losers and our winners, but more importantly, we just try to inform that that group of people, what we're doing, why we're doing it. And we really enjoy that forum of communicating. So feel free to follow us on Twitter and text us, send us messages and so forth. So with that, I'll call it a night. Hope you guys have a great evening, and we'll see you next month.
Thanks, Roy. Really enjoy following you on Twitter as well.
Thank you. Appreciate it, Carl.